Welcome back, traders. You're tuned into our continuing audiobook series of The New Trading for a Living by Dr. Alexander Elder, and today we dive into parts 7 to 11. This stretch of the book is where strategy meets execution. It's practical, powerful, and perfect for taking your trading to the next level. Let's break it down. Part 7, Trading Systems. This chapter explores how to build and evaluate a complete trading system, including entries, exits, and filters. Elder stresses the importance of testing and tailoring systems to fit your personality and discipline. Part 8, Trading Vehicles. Stocks, futures, options, forex. Elder helps you understand the pros and cons of each instrument so you can choose the right vehicle for your trading style. It's not just about what to trade, but how. Part 9, Risk Management. This part is crucial. Elder says, you are not in the business of making money, you are in the business of managing risk. Learn how to control drawdowns, position sizing, and emotional exposure before it costs you your capital. Part 10, Practical Details. From setting up your workstation to choosing a broker and tracking expenses, Elder shares real-world tips to make your trading smooth, efficient, and professional. Part 11, Good Record Keeping. Want to become a serious trader? Then you must track your trades. This part shows how to keep detailed records, journals, and performance reports, the habits that separate amateurs from pros. If you're finding value in this series, don't forget to hit that like button, subscribe for more audiobook episodes, and share this video with a fellow trader who needs it. Tap the bell so you don't miss the next book. Thank you for listening, and as always, stay focused, stay disciplined, and trade smart.
Part 7, Trading Systems. A system is a set of rules for finding, entering, and exiting trades. Every serious trader has one or more systems. Compare this to a surgeon who has systems for performing operations. He doesn't waste time and energy deciding whether to order anesthesia, where to make the cut, or how to find the sick organ. He follows a well-established routine, which leaves him free to think about strategic issues, finesse his technique, or deal with any complications. Some people use strictly defined systems that leave very little room for personal judgment. We call them mechanical traders. Others use systems that leave plenty of room for personal decisions. We call them discretionary traders. There is a very thoughtful discussion on matching one's personality type to various trading styles in Richard Weissman's book, Mechanical Trading Systems. Whatever approach you take, the key advantage of any system is that you design it when the markets are closed and you feel calm. A system becomes your anchor of rational behavior amidst the turbulence of the market. It goes without saying that a proper system is written down. This needs to be done because it's easy to forget some essential steps when stressed by live markets. Dr. Adil Gawand, in his remarkable book, The Checklist Manifesto, makes a convincing case for using checklists to raise performance levels in a large variety of demanding endeavors, from surgery and construction to trading. A mechanical trader develops a set of rules, back-tests them on historical data, and then puts his system on autopilot. Going forward, his software starts flashing orders for entries, target, and stops, and a mechanical trader is supposed to place them exactly as shown. Whether he'll stick to his plan or attempt to tweak or override those signals is another story, but that's how the system is supposed to work. An amateur feels relieved that a mechanical system, either his own or purchased from a vendor, will relieve him from the stress of decision-making. Unfortunately, market conditions keep changing, and mechanical systems eventually get out of gear and start losing money. The market is not a mechanical entity that follows the laws of physics. It is a huge crowd of people acting in accordance with imperfect laws of mass psychology. Mechanical methods can help, but trading decisions must take psychology into account. A professional trader with a mechanical system continues to monitor its performance like a hawk. He knows the difference between a normal drawdown and a period when a system goes out of gear and has to be shelved. A professional trader can afford to use a mechanical system precisely because he is capable of discretionary trading. A mechanical system is an action plan, but some degree of judgment is always required, even with the best and most reliable plans. A discretionary trader approaches each day in the markets afresh. He tends to examine more factors than a mechanical trader, weigh them differently at different times, and be more attuned to changes in current market behavior. A good discretionary system, while giving you plenty of freedom, includes several inviolate rules, especially in the area of risk management. Both approaches have pluses and minuses. On the plus side, mechanical trading can be less emotionally tense. You build your system, turn it on, and go about your life without watching every tick. On the minus side, these living and breathing markets have a sneaky way of changing their tunes and behaving differently from how they did when you built your system. The main plus of discretionary trading is the openness to fresh opportunities. Its biggest minus is that people's judgment tends to slip under stress when they become excited by greed or frightened by sharp moves. In my experience, mechanical traders tend to deliver more steady results, but the most successful traders use discretionary methods. Your choice is likely to depend on your temperament. That's how we make some of our most important decisions in life: where to live, what career to pursue, whom to marry. Our key choices stem from the innermost core of our personalities rather than rational thought. In trading, cooler and more obsessional people tend to gravitate toward mechanical trading, while the more swashbuckling types turn to discretionary trading. Paradoxically, at the high end of performance, these two approaches begin to converge. Advanced traders combine mechanical and discretionary methods. For example, a friend who is a dyed-in-the-wool mechanical trader uses 3 systems in his hedge fund, but keeps rebalancing capital allocated to each of them. He shifts millions of dollars from system A to system B or C, and back again. In other words, his discretionary decisions augment his systematic trading. I am a discretionary trader, but follow several strict rules that prohibit me from buying above the upper channel line, shorting below the lower channel line, or putting on trades against the impulse system described below. These mechanical rules reduce the number of bad discretionary trades. Much of this book deals with discretionary trading, but you can use the tools described in it for mechanical trading. I wrote this book to help both types of traders. 38. System testing, paper trading, and the 3 key demands for every trade. Before trading real money with a system, you need to test it, whether you developed it yourself or bought it from a vendor. This can be done in one of 2 ways. One is back testing. Apply your system's rules to a stretch of historical data, usually several years' worth. The other is forward testing. Trade small positions with real money. Serious traders begin with backtesting, and if its results look good, switch to forward testing. If that works well, they gradually increase position size. Looking at printouts of historical results is a nice start, but don't let good numbers lull you into a false sense of security. The profit-loss ratio, the longest winning and losing streaks, the maximum drawdown, and other parameters may appear objective, but past results don't guarantee the system will hold up in the real world of trading. You may see a very nice printout, but what if, once you begin to trade real money, that system delivers 5 losses in a row? Nothing in your paper testing will have prepared you for that, but it happens all the time. You grit your teeth and put on another trade, another loss. Your drawdown is deepening, and then the system flashes a new signal. Will you put on the next trade? Suddenly, an impressive printout looks like a very thin reed on which to hang the future of your account. There is a cottage industry of programmers who back test systems for a fee. Some traders, too suspicious to disclose their surefire methods, spend months learning to use testing software. In the end, only one kind of back testing prepares you to trade: manual testing. It is slow, time-consuming, and cannot be automated, but it's the only method that comes close to modeling real decision-making. It consists of going through historical data one day at a time, scrupulously writing down your trading signals for the day ahead, and then clicking one bar forward and recording new signals and trades for the next day. Begin by downloading daily price and volume data for your trading vehicle for a minimum of 2 years. For futures, you may use continuous contracts. Open a chart, and without looking, swing immediately to its very beginning. Open your spreadsheet, write down your system's rules at the top of the page, and create columns for dates, prices, and signals. Open 2 windows in your analytic program, one for your weekly chart and its indicators, the other for the daily chart. The 2 most important keyboard keys for testing are Alt and Tab because they let you switch between windows and programs. As you click forward, one day at a time, trends and trading ranges will slowly unfold and challenge you. At that point, you'll be doing much more than testing a set of rules. Moving ahead one day at a time will test and improve your decision-making skills. This one bar at a time testing is vastly superior to what you can get from back testing software. How will you deal with gap openings, when the market leaps above your buy level or drops below your stop at the opening bell? What about limit moves in futures? Looking forward one day at a time and writing down your signals and decisions, will get you as close to real trading as you can without risking cash. It'll keep you focused on the raw right edge of the market. You'll never get that from a neat printout of a system test. Manual testing will improve your ability not only to understand the markets, but to make decisions. If one bar at a time testing shows positive results, start trading small positions with real money. These days, with brokerage commissions as low as $1 for buying or selling 100 shares, you can test your indicators and systems while risking tiny amounts. Be sure to keep good records, and if your real money results continue positive, start increasing the size of your trades. Do it in steps, all the way up to your normal trade size. Paper trading. Paper trading means recording your buy and sell decisions and tracking them like real trades, but with no money at risk. Beginners may start out paper trading, but most people turn to it after getting beat up by the markets. Some even alternate between real and paper trades and can't understand why they seem to make money on paper, but lose whenever they put on a real trade. There are 3 reasons. First, people are less emotional with paper trades and good decisions are easier to make with no money at risk. Second, in paper trades, you always get perfect fills, unlike real trading. Third, and most important, good trades often look murky when you consider them. The easy-looking ones are more likely to lead to problems. A nervous beginner jumps into obvious-looking trades and loses money, but paper trades the more challenging ones. It goes without saying that hopping between real and paper trades is sheer nonsense. You either do the one or the other. Psychology plays a huge role in how your trades turn out, and that's where paper trading fails to deliver. Pretend trading with no money at risk is like sailing on a pond. It does little to prepare you for real sailing on a stormy sea. There is only one good reason to paper trade: to test your discipline as well as your system. If you can download your data at the end of each day, do your homework, write down your orders for the day ahead, watch the opening and record your entries, then track your market each day, adjusting your profit targets and stops. If you can do all of this for several months in a row, recording your actions, without skipping a day, then you have the discipline to trade real money. An impulsive person who trades for entertainment will not be able to paper trade that way because it requires real work. You may open an account with one of several websites set up for paper trading. Enter your orders, check whether they have been triggered, and write down those fills. Enter all paper trades in your spreadsheet and your trading diary. If you have the willpower to repeat this process daily for several months, then you have the discipline for successful real trading. Still, there is no substitute for trading real money because even small amounts rev up emotions more than any paper trade. You'll learn much more from even small real trades than from months of paper trading. In recent years, I've had a front row seat watching traders progress from paper trading to profitable real money trading. In Spike TradeCom, we reduce fees for members who contribute picks, creating an incentive to do homework. The discipline of submitting a weekly trade plan with entry, target, and stop gets people into the habit of being organized and focused. As their picks improve, they start earning performance bonuses in our weekly competition. At that point, I may receive an email saying that while they're doing well in the competition, their private trading lags behind. I tell them they're on the right track and to continue what they're doing. Sure enough, several months later, their new skills migrate into real trading. Now they may write that their private trading is better than their performance in the competition. Sure, I reply, it's because you pay more attention to real money trades. Speaking of trade setups, it's essential to write down all relevant numbers before you enter a trade. You're more objective before you put any money at risk. Once in a trade, you'll be tempted to give it more room to run. That's how losers turn small drawdowns into disasters. I once consulted a man who refused to take a $200 loss until it ran into a $98,000 wipeout. I'll focus on risk and money management in a later chapter when I discuss the concept of the iron triangle of risk control. At this point, I only want to make clear that risk management is the essential part of serious trading. Forget the days when you would look at the ceiling and say, I'll trade 500 shares, I'll trade 1,000 shares, or any other arbitrary number. Later in this book, you'll learn a simple formula for sizing your trades based on your account and risk tolerance. At the time of this writing, I have 3 strategies that I trade. My favorite is a false breakout with a divergence. My second choice is a pullback to value during a powerful trend. That's the strategy of the trade shown on the screen, figure 38.1. Last, I occasionally fade an extreme bet on a reversal of an overstretched trend. Each of these strategies has its rules, but the key point is this: I'll only take a trade that fits one of them. No chasing of random cars for this old dog. 3 key demands for every trade. There are 3 essential angles that must be considered for every planned trade. We'll briefly review them here and then elaborate in the chapters on specific trading systems and risk management. The discipline of these 3 demands is essential for anyone serious about trading. 39. Triple Screen Trading System. I developed this system and first presented it to the public in an April 1986 article in Futures magazine. I've been using it for trading since 1985, and it stood the test of time. I continue to tweak it, adding or changing minor features, but its basic principle remains unchanged, making trading decisions using a sequence of timeframes and indicators. Triple Screen applies 3 tests or screens to every trade. Many trades that seem attractive at first are rejected by one or another screen. The trades that pass the triple screen test are much more likely to succeed. Triple Screen combines trend-following indicators on long-term charts with counter-trend oscillators on the intermediate charts. It uses special entry techniques for buying or selling short as well as tight money management rules. The triple screen is more than a trading system. It is a method, a style of trading, trend-following indicators and oscillators. Beginners often look for a magic bullet, a single indicator for making money. If they get lucky for a while, they feel as if they discovered the royal road to riches. When the magic dies, amateurs give back their profits with interest and look for another magic tool. The markets are too complex to be analyzed with a single indicator. Different indicators give contradictory signals in the same market. Trend-following indicators rise during uptrends and give buy signals, while oscillators become overbought and give sell signals. Trend-following indicators turn down in downtrends and give signals to sell short, but oscillators become oversold and give buy signals. Trend-following indicators are profitable when markets are moving, but lead to whipsaws in trading ranges. Oscillators are profitable in trading ranges, but give premature and dangerous signals when the markets begin to trend. Traders say, the trend is your friend, and let your profits run. They also say, buy low, sell high. But why sell if the trend is up? And how high is high? Some traders try to average out the signals of trend-following indicators and oscillators, but those votes are easy to rig. Just as Republicans and Democrats in the United States keep redrawing electoral districts to create safe seats, traders keep selecting indicators that deliver the votes they want to see. If you use more trend-following tools, the vote will go one way, and if you use more oscillators, it'll go the other way. A trader can always find a group of indicators telling him what he wants to hear. The triple screen trading system is designed to filter out the disadvantages of trend-following indicators and oscillators while preserving their strengths. Choosing time frames, the factor of 5. Another major dilemma is that the trend of any trading vehicle can be both up and down at the same time, depending on what charts you use. A daily chart may show an uptrend, while a weekly chart shows a downtrend, and vice versa. We need a system to handle conflicting signals in different time frames. Charles Dow, the author of the Venerable Dow Theory, stated at the turn of the 20th century that the stock market had 3 trends. The long-term trend lasted several years, the intermediate several months, and anything shorter than that was a minor trend. Robert Ree, the great market technician of the 1930s, compared these 3 trends to a tide, a wave, and a ripple. He recommended trading in the direction of the tide, taking advantage of the waves and ignoring the ripples. Times have changed, and the markets have become more volatile. Computers are cheap, or even free. Live data have created better opportunities to capitalize on faster moves. We need a more flexible definition of time frames. The triple screen trading system is based on the observation that every time frame relates to the larger and shorter ones by approximately a factor of 5, see Chapter 32. Begin by asking yourself, what's your favorite time frame? You prefer working with the daily, 10-minute, or any other charts. Whatever time frame is your favorite, the triple screen calls that the intermediate time frame. The long-term time frame is 1 order of magnitude longer. The short-term time frame is 1 order of magnitude shorter. Once you select your intermediate time frame, you may not look at it until you examine the longer-term time frame and make your strategic decision there. For example, if you want to carry a trade for several days or weeks, then your intermediate time frame is likely to be defined by the daily charts. Weekly charts are one order of magnitude longer, and they'll determine the long-term time frame for you. Hourly charts are one order of magnitude shorter, and they'll determine the short-term time frame. Day traders who hold their positions for less than an hour can use the same principle. For them, a 5-minute chart may define the intermediate time frame, a 25-minute chart the long-term time frame, and a 2-minute chart the short-term time frame. Triple screen demands that you examine the long-term chart first. It allows you to trade only in the direction of the tide, the trend on the long-term chart. It uses the waves that go against the tide for entering positions. For example, when the weekly trend is up, daily declines create buying opportunities. When the weekly trend is down, daily rallies provide shorting opportunities. First screen, market tide. Triple screen begins by analyzing the long-term chart, one order of magnitude greater than the one you plan to trade. Most traders pay attention only to the daily charts, with everybody watching the same few months of data. If you begin by analyzing weekly charts, your perspective will be 5 times greater than that of your competitors. Begin by selecting your favorite time frame and call it intermediate. Not even glance at your intermediate chart because it'll prejudice you. Go immediately to the time frame one order of magnitude longer, your long-term chart. That's where you'll make your strategic decision to be a bull or a bear. After that, return to the intermediate time frame and start making tactical decisions, such as where to enter and where to place a stop. If you make the mistake of looking at the daily chart first, you'll be prejudiced by its patterns. First, make an unbiased decision on a long-term weekly chart before even glancing at the daily. The original version of triple screen used the slope of weekly MACD histogram as its weekly trend following indicator, figure 39.1. It was very sensitive and gave many buy and sell signals. Later I switched to using the slope of a weekly exponential moving average as my main trend following tool on long-term charts. After I invented the impulse system described in the following chapter, I began to use it for the first screen of triple screen. The impulse system combines the best features of the previous two methods. It is not quite as jumpy as MACD histogram, but is faster to react than the slope of an EMA. As you'll read in the next chapter, the impulse system colors every bar green when it's bullish, red when bearish, and blue when neutral. The impulse system doesn't tell you what to do. It's a censorship system that signals what you're prohibited from doing. When the impulse system is red, it prohibits you from buying. When it is green, it prohibits you from shorting. Glancing at a weekly chart when you want to buy, you have to wait until it stops being red. Glancing at a weekly chart when you want to sell short, you have to make sure it isn't green. The blue impulse permits you to trade either way. Some traders use other indicators to identify major trends. Steve Noties wrote an article in Futures magazine showing how he used the directional system as the first screen of triple screen. The principle is the same. You can use most trend following indicators, as long as you analyze the trend on the weekly charts first and then look for trades on the daily charts only in that direction. Screen 1 summary. Identify the weekly trend using a trend following indicator and trade only in its direction. A trader has 3 choices: buy, sell, or stand aside. The first screen of the triple screen trading system takes away one of those options. It acts as a censor who permits you only to buy or stand aside during major uptrends. It allows you only to sell short or stand aside during major downtrends. You have to swim with the tide or stay out of the water. Second screen, market wave. The second screen of triple screen identifies the wave that goes against the tide. When the weekly trend is up, daily declines point to buying opportunities. When the weekly trend is down, daily rallies point to shorting opportunities. The second screen applies oscillators, described in a previous section, to the daily charts in order to identify deviations from the weekly trend. Oscillators give buy signals when markets decline and sell signals when they rise. The second screen of the triple screen allows you to take only those signals on the daily charts that put you in gear with the weekly trend. Screen 2. Apply an oscillator to a daily chart. Use daily declines during weekly uptrends to find buying opportunities and daily rallies during weekly downtrends to find shorting opportunities. I like using force index, described in Chapter 30, for the second screen, but other oscillators such as RSI, Elder Ray, or Stochastic also perform well. When the weekly trend is up, triple screen takes only buy signals from daily oscillators but doesn't short their sell signals. The 2-day EMA of force index gives buy signals when it falls below its zero line, as long as it doesn't fall to a new multi-week low. When the weekly trend is down, force index gives shorting signals when it rallies above its center line, as long as it doesn't rise to a new multi-week high. Figure 39.2. Other oscillators, such as stochastic and RSI, see chapters 26 and 27, give trading signals when they enter their buy or sell zones. For example, when weekly MACD histogram rises but daily stochastic falls below 30, it identifies an oversold area, a buying opportunity. When the weekly MACD histogram declines but daily stochastic rises above 70, it identifies an overbought area, a shorting opportunity. Third screen entry technique. Third screen is your entry technique, and here you have quite a bit of latitude. You can go to an even shorter time frame, especially if you have live data, or you can use the same intermediate time frame. In the original Trading for a Living, I recommended looking for a ripple in the direction of the market tide, buying a breakout above the previous day's high for entering longs, or shorting a breakdown below the previous day's low for entering shorts. The downside of that approach was that the stops were quite wide. Buying a breakout above the previous day's high and placing a stop below that day's low could mean a wide stop after a wide range day, either putting a lot of money at risk or reducing position size. At other times, when the pre-breakout day was very narrow, placing the stop right below its low would expose that trade to the risk of being stopped out by market noise. The breakout technique is still valid, but I seldom use it. With the wide availability of intraday data, I like to switch to 25-minute and 5-minute charts and use day trading techniques for entering my swing trades. If you don't have access to live data and need to place an order in the morning before leaving for the day, I recommend an alternative approach which I call an average EMA penetration. Almost every rally is penetrated by occasional pullbacks, and you want to measure how deeply those pullbacks drop below your fast EMA. Look at the daily chart for the past 4 to 6 weeks, and if it is in an uptrend, measure how deeply prices penetrate below their EMA during normal pullbacks. Figure 39.3. Calculate an average penetration. Subtract yesterday's EMA level from today's and add this number to today's EMA. This will tell you where your EMA is likely to be tomorrow. Subtract your average penetration from your estimated EMA level for tomorrow and place your buy order there. You'll be fishing to buy at a bargain level during a pullback instead of paying a premium for buying a breakout. In the example in Figure 39.3, prices dipped below their fast EMA colored red on 4 occasions. An average downside penetration was $9.60. At the right edge of the screen, the 13-day EMA stands at $12.66. Deducting the recent average downside penetration from that number suggests that if today sees a spell of panic selling, we should place our buy order approximately $9 below the latest level of EMA. We can perform this calculation on a daily basis until we finally get an opportunity to buy low. This is a much more peaceful approach than chasing runaway prices. These rules are for buying during an uptrend. Reverse them for selling short in downtrends. Keep in mind, though, that downtrends tend to move twice as fast as uptrends. When the weekly trend is up and a daily oscillator declines, place a buy order below the fast EMA on the daily chart at a level of an average downside penetration. Alternatively, place a buy order 1 tick above the high of the previous day. If prices rally, you will be stopped in long automatically when the rally takes out the previous day's high. If prices continue to decline, your buy stop will not be touched. Lower your buy order the next day to the level 1 tick above the latest price bar. Keep lowering your buy stop each day until stopped in, or until the weekly indicator reverses and cancels its buy signal. When the weekly trend is down, wait for a rally in a daily oscillator and place an order to sell short above the fast EMA on the daily chart, at a level of an average upside penetration. Alternatively, place an order to sell short 1 tick below the latest bar's low. As soon as the market turns down, you will be stopped in on the short side. If the rally continues, keep raising your sell order daily. The aim of a trailing sell-stop technique is to catch an intraday downside breakout from a daily uptrend in the direction of a weekly downtrend. Triple screen in day trading. If you day trade, you may select a 5-minute chart as your intermediate time frame. Again, do not look at it, but go to a 25 or a 30-minute chart first, which will be your long-term chart. Make a strategic decision to be a bull or a bear on that longer-term chart, and then return to your intermediate chart to look for an entry and stop figure 39.4. A neat combination of timeframes for day trading stocks is a set of 39 and 8-minute charts. U.S. stock market is open from 9:30 a.m. to 4 p.m. 6.5 hours or 390 minutes. Using a 39-minute chart as your long-term screen neatly divides each day into 10 bars. Make your strategic decision there, and then drop down to a chart that's 5 times faster, an 8-minute chart for tactical decisions on entries and exits. Don't mash together too many time frames. If you're swing trading, you can briefly use an intraday chart to time your entry, but then return to the daily charts. If you keep watching intraday charts, chances are they'll shake you out of the trade prematurely. If you day trade, then the weekly chart is not really relevant, but you may take a quick look at the daily chart. The rule is this: select your favorite intermediate chart, pair it with a long-term chart that is 5 times longer, and go to work. Stops and profit targets. Proper money management is essential for successful trading. A disciplined trader takes his profits at targets, cuts losses short, and outperforms those who keep hoping and hanging on to bad trades. Before you enter a trade, write down 3 numbers: the entry, the target, and the stop. Placing a trade without defining these 3 numbers is gambling. Triple screen calls for setting profit targets using long-term charts and stops on the charts of your intermediate time frame. If you use weekly and daily charts, set profit targets on the weeklies but stops on the dailies. When buying a dip on a daily chart, the value zone on a weekly chart presents a good target. When day trading and using a 25-minute and a 5-minute pair, set the profit target on a 25-minute chart and the stop on a 5-minute chart. This helps you aim at the greater results while holding down the risk. The triple screen trading system calls for placing fairly tight stops. Since it has you trading in the direction of the market tide, it doesn't give much room to losing trades. Get on with the tide or get out. We'll return to this topic in Chapter 54, How to Set Stops. 40. The Impulse System. The idea for the impulse system came to me in the mid-1990s. I woke up in the middle of the night in a faraway hotel and sat up bolt upright in bed with the thought that I could describe any market move in any time frame, using only 2 criteria: inertia and power. By combining them, I could find stocks and futures with both bullish inertia and bullish power and trade them long. I could also find stocks and futures with both bearish inertia and power and sell them short. Good measure of the inertia of any trading vehicle is the slope of its fast EMA. A rising EMA reflects bullish inertia, while a falling EMA reflects bearish inertia. The power of any trend is reflected in the slope of MACD histogram. If its latest bar is higher than the previous bar, like the height of the letters MM, or less deep than the previous bar, like the depth of the letters YV, then the slope of MACD histogram is rising, and the power is pushing up. If the latest bar of MACD histogram is lower than the previous one, like the depth of the letters VY or the height of the letters MM, then the slope is declining, and the power is pushing down. When we use MACD histogram to define power, it doesn't matter whether it's above or below 0. What matters is the relationship of the last 2 bars of MACD histogram. It is relatively simple to program most software packages to color price bars or candles using the impulse system. If both indicators are rising, the bar is green bullish. If both are falling, the bar is red bearish. When the 2 indicators move against one another, that bar is blue neutral, figure 40.1. At first, I anticipated making the system automatic, buy green, short red, and cash checks on all colors. Backtesting the impulse system threw cold water on that idea. The automatic system caught every single trend, but it got whipsawed during trading ranges, where it kept flipping between green and red. I set the impulse system aside, but kept thinking about it. A few years later, it dawned on me, this wasn't an automatic trading system, it was a censorship system. It didn't tell me what to do, it told me what not to do. If either weekly or daily bar was red, no buying allowed. If either weekly or daily bar was green, no shorting permitted. Ever since that discovery, I've been using the impulse system for all my trades. I presented it to the public in my 2002 book, Come Into My Trading Room, which Barron's named a Book of the Year. The impulse system is becoming increasingly popular worldwide, and its terminology has entered the language of trading. And that's how I've been using the impulse system ever since figure 40.2. It keeps me out of trouble. I may develop my trading plans based on any number of ideas, signals, or indicators, and then the impulse system forces me to wait until it no longer prohibits an entry in the planned direction. In addition, the impulse system helps me recognize when a trend starts weakening and suggests an exit. Entries. Green and red bars of the impulse system show when both inertia and power are pointing in the same direction. At a green bar, bulls are in charge and the uptrend is accelerating. At a red bar, bears are dominant and the downtrend is in full swing. A fast EMA and MACD histogram may stay in gear with each other for only a few bars, but that's when the market travels fast, the impulse is on. Before you start applying the impulse system to your favorite market, remember the triple screen's insistence on analyzing markets in more than one time frame. Select your favorite time frame and call it intermediate. Multiply it by 5 to define your long-term time frame. If your favorite chart is daily, analyze the weekly chart first and make a strategic decision to be a bull or a bear. Use the impulse system to decide when you're permitted to enter long or short positions. If you're a short-term momentum trader, you can buy as soon as both time frames turn green and take profits as soon as one of them fades to blue. When trying to catch market turns, the best trading signals are given not by green or red, but by the loss of green or red colors. If a stock is falling, but your analysis indicates that a bottom is near, monitor the impulse system on weekly and daily charts. If even one of them shows red, the downtrend is still in force and buying is not permitted. When both time frames stop being red, they allow you to buy. If you think that a stock is forming a top and is about to turn down, examine the impulse system on both weekly and daily charts. If even one of them is green, it's a sign that the uptrend is still alive and no shorting is permitted. When the green disappears from both time frames, you may start shorting. The shorter a time frame, the more sensitive its signals. The impulse on a daily chart almost always changes colors ahead of the weekly. When day trading, the 5-minute chart changes colors ahead of a 25-minute chart. If my studies show that the market is bottoming and getting ready to turn up, I wait until the daily chart stops being red and turns blue or even green. Then I start watching the weekly chart, which is still red. As soon as it turns from red to blue, it allows me to buy. This technique saves me from buying too soon while the market is still declining. I use the same approach to shorting. When I think that a top is forming and the daily impulse stops being green and turns blue or even red, I closely monitor the weekly chart. As soon as it loses its green color, it permits me to go short. Waiting for both time frames to lose the color that is contrary to my plan helps ensure that I trade in gear with the market and not against it. Remember, the impulse system is a censorship system. It doesn't tell you what to do, but it clearly tells you what you're not allowed to do. You're not supposed to go against the censor. Many programs for technical analysis include a feature called conditional formatting. It allows you color price bars or candles depending on the slope of the EMA and MACD histogram. Brilliant programmer in Chicago named John Bruns used this feature when he included the impulse system in tool kits we call elder disks. If you use a platform that doesn't permit conditional formatting, you can still use the impulse system. Simply observe the slopes of the EMA and MACD histogram. Their combination will tell you what should be the color of the latest bar. If you know how to program, you can add more features to the impulse system. You can test different EMA lengths or MACD settings, looking for those that work best in your market. A day trader can program sound alarms to monitor color changes in several markets without being glued to the screen. Exits. If you're a short-term momentum trader, close out your trade as soon as the color of the impulse system stops supporting the direction of your trade, even in one of the two time frames. Usually, the daily MACD histogram turns ahead of the weekly. When it ticks down during an uptrend, it shows that the upside momentum is weakening. When the buy signal disappears, take profits without waiting for a sell signal. Reverse this procedure in downtrends. Cover shorts as soon as the impulse system stops being red, even in one of the two time frames. The most dynamic part of the decline is over, and your momentum trade has fulfilled its goal. The impulse system encourages you to enter cautiously but exit fast. This is the professional approach to trading. Beginners tend to do the opposite, jump into trades and then take forever to exit, hoping for the market to turn their way. A swing trader may stay in a trade, even if one of the time frames turns blue. What he should never do is stay in a trade against the color. If you're long and one of the time frames turns red, it is time to sell and go back to the sidelines. If you're short and the impulse system turns green, it signals to cover your short position. The impulse system helps identify islands of order in the ocean of market chaos by showing when the crowd, usually so aimless and disorganized, becomes emotional and starts to run. You enter when a trend pattern emerges and exit when it starts to sink back into chaos. 41. Channel trading systems. Market prices tend to flow in channels like rivers in their valleys. When a river touches the right edge of its valley, it turns left. When it touches the left rim of its valley, it turns right. When prices rally, they often seem to stop at an invisible ceiling. Their declines seem to stop at invisible floors. Channels help us anticipate where those support and resistance levels are likely to be encountered. Support is where buyers buy with greater intensity than sellers sell. Resistance is where sellers sell with greater intensity than buyers buy. See Chapter 18. Channels show where to expect support and resistance in the future. Channels help identify buying and selling opportunities and avoid bad trades. The original research into trading channels was conducted by J.M. Hurst and described in his 1970 book, The Profit Magic of Stock Transaction Timing. The late great mathematician Benoit Mandelbrot was hired by the Egyptian government to create a mathematical model of cotton prices, the main agricultural export of that country. After extensive study, the scientist made this finding: prices oscillate above and below value. It may sound simple, but in fact it's profound. If we accept this mathematical finding, and if we have the means to define value and measure an average oscillation, we'll have a trading system. We'll need to buy below value and take profits at value, or sell short above value and cover at value. We have already agreed that value is in the zone between a short and a long moving averages. We can use channels to find normal and abnormal oscillations. 2 ways to construct a channel. We may construct a channel by plotting 2 lines parallel to a moving average, one above and another below. We may also vary the distance between the channel lines depending on that market's volatility, standard deviation channels. A symmetrical channel, centered around a moving average, is useful for trading stocks and futures. Standard deviation channel, sometimes called Bollinger Bands, is good for those who trade options. Channels mark the boundaries between normal and abnormal price action. It is normal for prices to stay inside a well-drawn channel, and only unusual events push them outside. The market is undervalued below its lower channel line and overvalued above its upper channel line. Symmetrical channels. Earlier we've discussed using a set of 2 moving averages for trading. See Chapter 22. With such a pair, use the slower one as the backbone of your channel. For example, if you use 13-day and 26-day EMAs, draw your channel lines parallel to the 26-day EMA. The width of a channel depends on the coefficient selected by the trader. This coefficient is usually expressed as a percentage of the EMA level. Upper channel line equals EMA plus channel coefficient EMA, lower channel line equals EMA minus channel coefficient EMA when setting a channel for any market. Start with 3% or 5% of the EMA and keep adjusting those values until a channel contains approximately 95% of all price data for the past 100 bars, about 5 months on a daily chart. This is similar to trying on a shirt. You look for the one that fits not too loose or too tight, with only your wrists and neck sticking out. Only the extreme prices will protrude outside of a well-drawn channel. Volatile markets require wider channels, while quiet markets require more narrow channels. Cheaper stocks tend to have higher coefficients than expensive ones. Long-term charts require wider channels. As a rule of thumb, weekly channel coefficients are twice as large as daily ones. I used to plot channels by hand until my programmer wrote an add-on for several software packages called an auto envelope. It automatically plots correct channels for any trading vehicle in any time frame, figure 41.1. It's included on Elder disks for several popular programs. Mass psychology. An exponential moving average reflects the average consensus of value in its time window. When prices are near their moving average, the market is fairly valued. When they decline near the lower channel line, the market is undervalued. When prices rise to the upper channel line, the market is overvalued. Channels help find buying opportunities when the market is cheap and shorting opportunities when the market is dear. When prices fall below their moving average, bargain hunters step in. Their buying as well as short covering by bears stops declines and lifts prices. When prices rise above value, sellers see an opportunity to take profits on long positions or go short. Their selling caps the rise. When the market sinks to the bottom of a depression, its mood is about to improve. Once it rises to the height of its mania, it's about to start calming down. A channel marks normal limits of mass optimism and pessimism. The upper channel line shows where bulls run out of steam, while the lower channel line shows where bears become exhausted. At the upper channel line, bears have their backs against the wall as they fight off the bulls. At the lower channel line, bulls have their backs against the wall and fight off the bears. We all fight harder when our backs are against the wall, and that's why channels tend to hold. If a rally shoots out of a channel and price is close above it, it shows that the uptrend is exceptionally strong. When a rally fails to reach the upper channel line, it is a bearish sign, as it shows that bulls are becoming weaker. The reverse applies to downtrends. My friend Carrie Loveborn finessed this idea by plotting not one but 3 sets of channels around a moving average. The width of his channels is driven by average true ranges, see Chapter 24. His 3 channels are set at 1, 2, and 3 adders away from the moving average. Normal moves tend to stay within 1 ATR channels, while only extreme moves go outside of 3 adders, indicating a reversal is near figure 41.2. Channels help us remain objective, while other traders get swept up in mass bullishness or bearishness. When prices rally to the upper channel line, you see that mass bullishness is being overdone, and it's time to think about selling. When prices drop near the lower channel line and everyone turns bearish, you know that it's time to think about buying instead of selling. Trading rules. Amateurs like to bet on long shots. They tend to buy upside breakouts and short if they ever sell short downside breakouts. When an amateur sees a breakout, he expects riches from a major new trend. Professionals, on the other hand, tend to trade against deviations and for a return to normalcy. The pros know that most breakouts are exhaustion moves that are soon aborted. That's why they like to fade breakouts, trade against them, selling short as soon as an upside breakout stalls, and buying when a downside breakout starts returning into the range. Breakouts can produce spectacular gains when a major new trend blows out of a channel, but in the long run, it pays to trade with the pros. Most breakouts fail and are followed by reversals, which is why channel lines mark attractive zones for entering trades against breakouts, with profit targets in the value zone. You can use moving average channels as a standalone trading method or combine it with other techniques. Gerald Appel, a prominent market researcher and money manager in New York, recommended these rules for trading with channels. 1. Draw a moving average and build a channel around it. When a channel is relatively flat, the market is almost always a good buy near the bottom of its trading channel and a good sell near the top. 2. When the trend turns up and a channel rises sharply, an upside penetration of the upper channel line shows very strong bullish momentum. It indicates that you will probably have one more chance to sell in the area of the highs that are being made. It is normal for the market to return to its moving average after an upside penetration, offering an excellent buying opportunity. Sell your long position when the market returns to the top of the channel. This also works in reverse during sharp downtrends. A breakout below the lower channel line indicates that a pullback to the moving average is likely to occur, offering another opportunity to sell short. When prices return to the lower channel line, it is time to cover shorts. The best trading signals are given by a combination of channels and other technical indicators. Figure 41.3. Indicators give some of their strongest signals when they diverge from prices. A method for combining channels and divergences was described to me by the late Manning Stoller. 1. A sell signal is given when prices reach the upper channel line while an indicator, such as MACD histogram, traces a bearish divergence. It shows that bulls are becoming weak when prices are overextended. 2. A buy signal is given when prices reach the lower channel line while an indicator traces a bullish divergence. It shows that bears are becoming weak when prices are already low. We must analyze markets in multiple time frames. Look for buys on the daily charts when prices are rising on the weeklies. Look for shorting opportunities on the dailies when prices are sinking on the weekly charts. 3. Go long near the moving average when the channel is rising and take profits at the upper channel line. Go short near the MA when the channel is falling and take profits at the lower channel line. When a channel rises, it pays to trade only from the long side. buying in the value zone which lies between the fast and slow-moving averages, and then selling at the upper channel line. When a channel declines, it pays to short in the value zone and cover at the lower channel line. Standard deviation channels, Bollinger Bands. The unique feature of these channels is that their width changes in response to market volatility. Their trading rules differ from those of regular channels. 1. Calculate a 21-day EMA. 2. Subtract the 21-day EMA from each closing price to obtain all the deviations from the average. 3. Square each of the deviations and get their sum to obtain the total squared deviation. 4. Divide the total squared deviation by the EMA length to obtain the average squared deviation. 5. Take the square root of the average squared deviation to obtain the standard deviation. These steps, outlined by Bollinger, have been included in many software packages. A band becomes wider when volatility increases, but it narrows down when volatility decreases. A narrow band identifies a sleepy, quiet market. Major market moves tend to erupt from flat bases. Bollinger Bands help identify transitions from quiet to active markets. These bands are useful for options traders because option prices are largely driven by swings in volatility. Narrow Bollinger Bands help you buy when volatility is low and options are relatively cheap. Wide bands help you decide to write options when volatility is high and options are expensive. When we return to options in the following chapters, you'll read that buying options is a loser's game. Professional traders write options. Wide Bollinger Bands can signal when to be more active with your writes. If you trade stocks or futures rather than options, it's better to use regular channels as profit targets. Trading is hard enough without trying to shoot at a moving target, such as a Bollinger Band. Part 8. Trading Vehicles. All trading vehicles are divided into several classes. Their charts may look similar on a computer screen, but don't let their looks deceive you. Each group has its pluses and minuses. They offer different profit opportunities and carry different risks. Choosing what to trade is among your most important market decisions. We'll review the following major groups to help you make a conscious decision on which to focus. Stocks, ETFs, options, CFDs, futures. Forks. Whichever group you select, make sure your trading vehicle meets two essential criteria: liquidity and volatility. Liquidity refers to the average daily volume compared with other vehicles in its group. The higher it is, the easier it'll be for you to get in and out of your trades. You may build a profitable position in an illiquid stock, only to lose at the exit due to especially bad slippage. I learned this lesson decades ago after building a 6,000 share position in a fairly inactive stock. When it began to sag, I decided to sell, and that's when I discovered that its average daily volume was only 9,000 shares. There were so few people trading it that my own sales began to depress its price. Taking several days to trade out of my 6,000 share lot felt like taking a fat cow through a very narrow gate and leaving large strips of its hide on gate posts. Now, I focus on U.S. stocks that trade over 1 million shares a day. That's where I can slip in and out of my trades unnoticed and unmolested. With a large number of traders, there are plenty of orders to buy and sell, and my slippage when it occurs is small. Volatility is the extent of average short-term movement of a trading vehicle. The higher the volatility of a trading instrument, the more opportunities it presents. Popular stocks tend to swing a lot. On the other hand, stocks of many utility companies that are quite liquid are very hard to trade because of low volatility. They tend to stay in narrow ranges. There are several ways to measure volatility, but a good practical tool is beta. Compares any vehicle's volatility to its benchmark, such as a broad index. If a stock's beta is 1, it means that its volatility is equal to that of the S&P 500. A beta of 2 means that if the S&P rises 5%, the stock is likely to rally 10%, but it is also likely to drop 10% if the S&P falls by 5%. A beta of 0.5 means that the stock is likely to rise or fall by half of the percentage of the S&P. It would be better for a beginner to focus on low beta vehicles. You can find betas for most stocks on all key financial websites, starting with Yahoo Finance. Betas are like trail markers on ski slopes, green for beginners, blue for intermediate skiers, and black diamonds for experts. Time zones. Globalization has lured many people to trade far away from home. I meet traders in Australia who trade US stocks and talk with traders in the United States who wrestle with European indexes. Still, you should think twice before trading far away from your own time zone. Your data screen is connected to the world, but your physical self is rooted in the area where you live. If you trade while sleepy, you put yourself at a disadvantage. If your head is on the pillow while your trade is open on the other side of the globe, you make it easier for your competitors to pick your pockets. Some time zones are easier to trade than others. For example, it is comfortable to trade the US markets from Western Europe, where the New York Stock Exchange opens at 3:30 p.m. and closes at 10 p.m. It is very hard to trade US markets from Asia, where the time difference is likely to be 12 hours. There are always exceptions to a rule, and you may enjoy trading at night. But if you feel tired and sleepy, don't push yourself but find a local market. Long or short, there's more to trading than buying and waiting for prices to rise. Markets are two-way streets, they go down as well as up. Beginners only buy, but experienced traders are comfortable with selling short. In a nutshell, to make money shorting, you identify a vehicle that you expect to drop, borrow it from your broker, giving him a deposit, and sell it. After it declines, you buy it back at a cheaper price, return the borrowed shares to your broker, and get your deposit back. Your profit is the difference between the higher selling and lower buying prices. This is the same as in buying, only the process is reversed: sell first, buy later. Of course, shorting is too complex a topic to cover in 2 paragraphs, which is why I refer you to my latest book prior to this one, The New Sell and Sell Short: How to Take Profits, Cut Losses, and Benefit from Price Declines, John Wiley & Sons, 2011. 42. Stocks. A stock is a certificate of ownership of a business. If you buy 100 shares of a company that had issued 100 million shares, you'll own 1/1,000,000th of that firm. If other people want to own that business, they'll have to bid for your shares. When masses of people start liking the prospects of a business, their orders for its shares will push up the stock price. If they don't like the outlook of that business, they'll start selling their shares, depressing prices. Public companies try to make their shares more attractive in order to push up share prices because it helps them raise more equity or issue debt. Top executives' bonuses are often tied to stock prices. Fundamental values, especially earnings, drive prices in the long run, but, as John Maynard Keynes, the famous economist and a canny stock picker, once retorted, in the long run we're all dead. Markets are full of cats and dogs, stocks of companies with feeble or non-existent earnings that at some point fly through the roof, defying gravity. Stocks of new sexy industries can levitate on expectations of future earnings rather than any real profits. Stocks of solidly profitable, well-run companies may drift sideways or down if the crowd isn't excited about their outlook. Warren Buffett is fond of saying that buying a stock makes you a partner of a manic depressive fellow he calls Mr. Market. Each day, Mr. Market runs up to you and offers to buy you out or sell his shares to you. Most of the time, you should ignore him because he's crazy, but occasionally Mr. Market becomes so depressed that he offers you his shares for a song, and that's when you should buy. At other times, he becomes so manic that he offers an insane price for your shares, and that's when you should sell. Buffett's idea is brilliant in its simplicity, but hard to implement. Mr. Market's mood is so contagious that it sweeps most of us off our feet. People want to sell when Mr. Market is depressed and buy when he is manic. To be a successful trader, you must stand apart from the crowd. You need to define objective criteria that will help you decide how high is too high and how low is too low. Buffett makes his decisions on the basis of fundamental analysis and a fantastic gut feel. Traders can use the tools of technical analysis described in this book. What stocks will you trade? There are more than 20,000 of them in the United States and even more abroad. Beginners tend to spread themselves too thin. Afraid to miss an opportunity, they buy scanning software. A person who doesn't have a clear idea of how to trade a single stock will not be helped by tracking thousands. He'll be much better off focusing on a handful of stocks and following them every day. We'll return to the question of stock selection in Part 10, Practical Details. In brief, it's a good idea to limit your pool of trading candidates. That group can be small or large, depending on your skills and available time. A Greek friend of mine calls his watch list of 200 stocks his harem. He's owned every one of them in the past. He reviews them on weekends, selecting fewer than 10 that he may take for a spin in the coming week. I have 2 pools in which I fish for trading ideas. On weekends, I run the 500 component stocks of the S&P 500 through my divergent scanner and zoom in on stocks flagged by that scan, selecting a handful that I'll consider trading during the coming week. Second, I review spike picks on weekends, figuring that among a dozen top traders submitting their favorite picks, there is bound to be at least one that I'll want to piggyback. The number of stocks I closely monitor during the week is always in single digits. This is just my style. I have friends who monitor several dozen stocks at any given time. Only you can tell what number is right for you, but you should track only as many as you can focus on. 43. ETFs. An exchange-traded fund, ETF, is an investment vehicle that trades like a stock. Different ETFs hold different types of assets, such as stocks, commodities, or bonds, and they usually trade close to their net asset values. There are ETFs designed to track indexes, sectors, countries, commodities, bonds, futures, and forks. The leveraged ETFs are designed to move double or triple the distance of the underlying index. There are also inverse ETFs and leveraged inverse ETFs that trade opposite to their underlying assets. When an index falls, its inverse ETF rises and vice versa. The number of ETFs has reached thousands in recent years. With so many choices, what's there not to like about ETFs? Actually, quite a lot. The industry keeps quiet about the fact that there are 2 ETF markets. The primary market is reserved for authorized participants, large broker-dealers who have agreements with the ETF distributors to buy or sell large blocks, consisting of tens of thousands of ETF shares. These middlemen buy at wholesale and then sell to you at retail. You, as a private trader, always sit in the back of the bus, in the secondary market. An active trader friend who reviewed this chapter added, I believe that authorized participants can also obtain ETF shares to short in large lots. My broker always tells me there are none available, not even of broadly held ETFs, which I can't imagine they don't have lots of in inventory. When I ask them about this, they stonewall. I wonder how such a shorting transaction by an authorized participant is accounted for. I wonder if it somehow ends up as paired transactions, both an up-volume purchase and a down-volume sale, canceling each other out. If so, the added selling pressure would be hidden from view. Administrative expenses incurred by ETFs dampen investors' returns. According to a study by Morgan Stanley, ETFs missed their 2009 targets by an average of 1.25%, which was double the size of their miss in 2008. Those percentages are your haircuts for the privilege of trading ETFs rather than individual stocks. The more exotic the index tracked by an ETF, the greater your haircut. Some ETFs lose value so fast that their issuers repeatedly perform reverse splits in order to raise prices back into double digits. With the passage of time, those ETFs sink back into single digits, and then their issuers perform another reverse split to make their ETFs appeal to new suckers. A friend of mine lost over $1 million last year. He anticipated a market decline and bought an ETF of a volatility index. Volatility rises when markets fall. Sure enough, the market dropped 10% and volatility spiked, but his ETF went down instead of up, figure 43.1. Many ETFs track their underlying indexes in a shabby manner. After giving commodity ETFs a try, I wouldn't touch them with a 10-foot pole, having experienced several days during which the underlying commodity went up, while my commodity ETFs went down. I stopped trading country ETFs after running into several situations in which a country index would rise to a new high, while my ETF would stay well below the breakout level, figure 43.2. The leveraged ETFs are more futures-laden than non-leveraged ETFs and have much greater rollover losses each month. The disadvantages that retail investors suffer are magnified in the leveraged ETFs. They may track their underlying vehicles more or less correctly during a single trading session, but deviate widely with the passage of time. The only ETFs that trade more or less decently are broadly based ones, such as SBY and QQQ. Overall, ETFs attract many unsophisticated retail clients, but the pervasive haircuts and poor tracking of the underlying securities slant the field against them. Remember an important principle: Tanstaffel, there ain't no such thing as a free lunch. When it comes to ETFs, buyer beware. 44. Options. An option is a derivative instrument, a bet that another security, such as a stock, an index, or a future, will reach a certain price by a certain date. A call gives its holder a right, but not an obligation, to buy a certain quantity of a specified security at a specified price at a specified time. It is a bet on a price increase. A put is a right, but not an obligation, to sell a certain quantity of a specified security at a specified price at a specified time. It is a bet on a price drop. There are two parties in every options trade, a buyer and a seller, also called a writer. Buyers buy options, while writers create options and sell them to buyers. The key point to keep in mind is that option buyers as a group lose money over time, despite occasional lucky trades. At the other end of the table, options writers as a group make steady money despite occasional losses. Writers create options out of thin air to meet demand from option buyers. One of my students, a market maker on the floor of the American Stock Exchange, said to me, "Options are a hope business. You can buy hope or sell hope. I am a professional, I sell hope. I come to the floor in the morning and find what the public hopes for. Then I price that hope and sell it to them." Each option has an exercise price, also called strike price. If a stock fails to reach that price before the exercise date, the option expires worthless and the buyer loses what he paid, while the writer keeps his loot, whose polite name is premium. An option is at the money when the current price of the underlying security equals the exercise price. A call is out of the money when the current price of the underlying security is below the exercise price. A put is out of the money when the current price of the underlying is above the exercise price. The farther out of the money, the cheaper the option. A call is in the money when the current price of the underlying security is above the exercise price. A put is in the money when the current price of the underlying is below the exercise price. An option can be at the money, out of the money, or in the money at different times in its life, as the price of the underlying security fluctuates. The price of every option has two components, an intrinsic value and a time value. An option's intrinsic value rises above zero only when it's in the money. If the exercise price of a call is $80 and the underlying security rises to $83, the intrinsic value of your call will be $3. If the security is at or below $80, the intrinsic value of that call is zero. The other component of an option's price is time value. If the stock trades at $74 and people pay $2 for an $80 call, the entire $2 represents time value. If the stock rises to $83 and the price of the call jumps to $4, $3 of that is intrinsic value. $83, $80. While $1 is time value, the hope that this stock will rise even higher during the remaining life of that option. Option prices depend on several factors. The farther out of the money the exercise price, the cheaper the option. The underlying security must travel a longer distance to make the option worth anything before it expires. The closer the expiration day, the cheaper the option. It has less time to fulfill the hope. The speed with which an option loses value is called time decay, which doesn't occur in a straight line but becomes steeper as the expiration nears. The less volatile the underlying security, the cheaper the option, because it has a smaller chance of making a large move. Minor factors influencing option prices include the current level of interest rates and the dividend rate of the underlying stock. Different factors that impact option pricing may clash and partly cancel each other out. For example, if a market drops sharply, reducing the value of calls, the increased volatility will lift option values, and the calls may lose less than expected. There are several mathematical models, such as black skulls, widely described in options literature, that are used to determine what is called a fair value of any option. Buying options. The simplest and easiest approach to options is to buy them. That's exactly what beginners do, and unless they learn quickly and change, their accounts are doomed. This is the standard line of brokerage house propaganda. Options offer leverage and ability to control large positions with a small outlay of cash. The entire risk of an option is limited to the price you pay for it. Options allow traders to make money fast when they're right, but if the market reverses, you can walk away and owe nothing. A circumflex, they fail to mention that in order to profit from buying an option, you must be right in 3 ways. You must choose the right stock, predict the extent of its move, and forecast how fast it'll get there. If you're wrong on even one of these 3 choices, you'll lose money. Ever tried tossing a ball through 3 rings at an amusement park? This triple complexity makes buying options a losing game. A stock, an index, or a future can do one of 3 things: rise, fall, or stay flat. When you buy a call, you can profit only if the market rises. You lose if it goes down or stays flat. You can lose even if it rises, but not fast enough. When you buy a put, you win only if the market falls fast enough. An option buyer makes money only if the market goes his way at a good enough speed, but loses if it moves his way slowly, stays flat, or goes against him. An option buyer has 1 chance out of 3 to win, but the odds are 2 out of 3 in favor of an option writer. No wonder the pros write options. A pro sells a call, and if a stock drops, stays flat, or even rises slowly, that call will expire worthless and he'll keep the premium. He sells poor buyers hope, and as that hope turns out to be worthless, he keeps their money. Options attract hordes of small traders who can't afford to buy stocks. To get a bigger bang for their buck, they buy calls as if those were substitutes for stocks. This doesn't work because options move differently from stocks. Gullible amateurs buy empty hopes, which the pros are delighted to sell to them. Beginners, gamblers, and undercapitalized traders make up the majority of option buyers. Just think of all the money those hapless folks lose in their eagerness to get rich quick. Who gets all that money? Some of it goes for brokerage commissions, but the bulk flows into the pockets of option writers. Well-capitalized professionals write options rather than buy them. Option writing is a capital-intensive business. You need hundreds of thousands of dollars at a minimum to do it right, and most successful writers operate with millions. Writing options is a serious game for knowledgeable, disciplined, and well-capitalized traders. If your account is too small for option writing, wait until it grows bigger. Markets are like pumps that suck money out of pockets of the poorly informed majority and into the wallets of a savvy minority. Smart traders in any market look for situations in which the majority does something one way, while a small, moneyed minority does the opposite. Options are a great example of this rule. Writing options. There are 2 main types of option writing. Covered writers buy a stock and write options against it. Naked writers write calls and puts on stocks they don't own. Covered writers own underlying securities. For example, a fund may hold a large position in IBM stock and sell calls against it. If the stock doesn't rise to the exercise price during the life of those calls, the options will expire worthless. The covered writer will add his premium to the fund and write a new call with a new expiration date. If IBM does rise to the exercise price and gets called, they'll deliver their stock at its strike price, collect the money, and use the freed-up capital to buy another stock and write calls against it. Large funds tend to use computerized models for buying stocks and writing covered calls. Covered writing is a mathematically demanding, capital-intensive business. Most serious players spread their costs, including staff and equipment, across a large capital base. A small trader doesn't have much of an edge in this expensive enterprise. Covered writing was very profitable in the early years of exchange-traded options. By now, the field is very crowded, and the returns have become thinner. Naked writers sell options without owning their underlying securities. They back up their rights with cash in their accounts. A naked writer collects his premium when he opens a trade, but his risk is unlimited if that position goes against him. If you own a stock, sell a covered call, and that stock rises to its exercise price and gets called, you have something to deliver. If you sell a naked call and the stock rises to or above its exercise price, you'll have to pay. Imagine selling calls on a stock that becomes a takeover play and opens $50 higher the next morning. You still have to deliver. This combination of limited rewards with unlimited risks scares most traders away from naked writing. But as usual, there's a gap between perception and reality. A far out-of-the-money option with a short time to the expiration is very likely to expire worthless, meaning the writer will profit. The risk-reward ratio in naked writing is better than it looks, and there are techniques for reducing the impact of a rare, adverse move. Savvy naked writers tend to sell out of the money calls and puts whose underlying stocks or futures are unlikely to reach their strike prices during the remaining life of an option. They sell not just hopes, but distant hopes. Good writers track volatility to find how far a stock is likely to move and then sell options outside of that range. This game goes into high gear during the week or two prior to option expiration, when the floor mints money out of thin air, selling naked puts and calls that have almost no chance of reaching their exercise price. Cautious writers close their positions without waiting for the expiration dates. If you write a call at 90 cents and it goes down to 10 cents, it makes sense to buy it back and unwind your position. You've already earned the bulk of potential profit, so why expose yourself to continued risk? It's cheaper to pay another commission, book your profits, and look for another writing opportunity. Becoming a naked writer requires iron discipline. The size of your writes and the number of positions must be strictly determined by your money management rules. If you sell a naked call and the stock rallies above its exercise price, it exposes you to the risk of ruin. You must decide in advance at what level you will cut and run, taking a relatively small loss. A naked seller cannot afford to sit and hope when a stock moves against him. Writer's choice. Time is the enemy of options buyers. Every buyer has lived through this sad sequence. They buy a call, the stock rises, but their option fades to zero, and they lose money. Buyers lose when the underlying security takes longer than expected to get to the level at which they can collect on their bet. Most options become worthless by their expiration date. What if we reverse this process and write rather than buy options? The first time you write an option and do it correctly, you'll experience the delicious sensation of time working in your favor. The option that you wrote loses some of its time value each day, making the premium you've collected safer. When the market goes nowhere, you still make money, as time value keeps evaporating, making it more likely that you'll keep the premium. If living well is the best revenge, then taking a factor that kills most options buyers, time, and making it work for you is a gratifying experience. Since each option represents a hope, it's better to sell empty hopes which are unlikely to be fulfilled. Take 3 steps before writing a call or a put. 1. Analyze the security against which you want to write options. Use triple screen to decide whether a stock, future, or an index is trending or non-trending. Use weekly and daily charts, trend-following indicators and oscillators to identify trends, detect reversals, and set up price targets. Avoid writing when earnings are about to be announced. Do not hold open positions during those potentially stormy days. 2. Select the type of option to write. If your analysis is bearish, consider writing calls, but if bullish, consider writing puts. When the trend is up, sell the hope that it will turn down, and when it's down, sell the hope it'll turn up. Do not write options when markets are flat and premiums low. A breakout from a trading range can hurt you. 3. Estimate how far, with a generous safety margin, the stock would have to run in order to change its trend. Write an option beyond that level. Write an option with a strike price the market is unlikely to reach before the option expiration. An objective tool that shows the degree of safety of your planned position is an indicator called delta, which we'll discuss below. Time decay. Options lose value with each passing day, but their rate of decay isn't steady. Options drop faster as the expiration date draws closer. Like a boulder rolling downhill, time decay becomes vertical at the final cliff. Time decay is bad for option buyers, but very good for option writers. You collect your premium the day you sell a call. The deeper it falls below the price at which you wrote it, the safer your premium. Time decay is a friend of the option writer, but an enemy of the option buyer. With that in mind, the sweet spot for an option writer is approximately 2 to 3 months from option expiration. That's when time decay starts gathering speed. It accelerates in the last few weeks of the option's life. When you write options close to the expiration, you benefit from faster time decay. You can get more money for options with longer lives, but don't be greedy. The goal of a writer is not to make a killing on any single trade, but to grind out steady income. Delta is a tool that shows the probability of the underlying security reaching your option's exercise price by its expiration date. It's one of several options tools, collectively called the Greeks. Each is named after a letter of the Greek alphabet. You can find delta for any stock, index, or ETF on many financial websites. especially those of brokerages that offer option services. A cautious option writer should aim to sell calls or puts whose delta isn't much above 0.10, meaning there is only a 10% chance of the exercise price getting hit before the expiration date. Remember, as an option writer, you don't want the underlying security to reach that price. You want to sell empty hopes. If 10% risk seems high, keep in mind that delta is derived without any reference to market analysis. If your decision is based on good technical analysis, your risk will be lower than what delta indicates. The temptation to sell naked options closer to the money and get fatter premiums is dangerous. The delta is likely to be high, meaning that a slight counter-trend move can push your position underwater. If you're going to write options, treat it like writing accident insurance policies. To make steady profits and sleep well at night, sell your auto insurance policies to ladies who only drive to supermarkets rather than to motorcycle daredevils. Limiting risk. A big options trader shared with me his technique of slicing the bid-ask spread. He puts in a low bid or a high ask, and then starts giving up a penny at a time until somebody bites. For example, he recently saw an option he wanted to write, i.e., sell. The bid was $1.18 and the ask $1.30, but he had no intention of selling at $1.18 and paying that huge spread. Instead, he put in his order to sell a large number of contracts at $1.29, a penny cheaper than the ask. No response. A few minutes later, he lowered his ask to $1.28, and suddenly a buyer materialized, snapped up his contracts, and then the bid-ask spread went back to $1.18, $1.30. My client finds there are large traders watching from the sidelines, not showing their hand, but willing to trade within the spread. He gets them to bite by giving up a penny at a time. Option writers can get hurt in one of three ways. Some overtrade, creating positions that are too large for their accounts. Assuming too much risk makes them nervous and unable to hold positions through any wiggles. Option writers also get hurt when they fail to run fast enough when an option moves against them. Finally, option writers can get blown out if they don't have a reserve against a major adverse move. The longer you trade, the greater the risk of a catastrophic event. A writer can grow careless selling naked options and pocketing profits. A smug feeling of self-satisfaction can blind him to reality. You must protect all trades, including naked options. Several suggestions. Set your profit-taking zone. Consider buying back your naked options. The option you write is a wasting asset. When the underlying security moves far from the exercise price, but there is still time left to the expiration, the price of the option you sold may fall near its rock bottom and lose value in tiny dribs and drabs. The loser who bought that option still has a bit of a chance that the market may reverse in his favor. He continues to hold that option like a lottery ticket, and once in a rare while his ticket may win. As a writer, why hold an open position that has already given you most of its potential profit? You have little to gain while remaining exposed to risk. After the option you sold loses half of its value, consider buying it back to close your profitable trade. By the time an option loses 80% of its value, you should be out of that trade. Use a mental stop loss on the option you sold. It is better to use mental stops here because many pros go fishing for stops of thinly traded options. Using mental stops requires iron discipline, another reason why option writing isn't a beginner's game. Set your mental stops both on the underlying security and the option itself. For example, you may sell a naked April 80 call on a stock trading at 70 and place your mental stop at 75. Get out of your naked option position before it gets into the money. Also, set a stop on your option. If it doubles in price, buy it back to cut the loss. If you sold an option for $1.50, buy it back if it rises to $3. It may hurt, but it'll be nowhere near the unlimited loss that makes people afraid to write options. Open an insurance account. You may write a put and the market crashes the next day, or you write a call and suddenly there is a takeover. You hope this never happens, but trade long enough and eventually everything will happen. That's why you need insurance. Nobody will write it for you, so you'll have to self-insure. Open a money market account, and every time you close out a profitable naked writing position, throw 10% of your profit into that account. Do not use it for trading. Let your insurance account grow with each new profit. ready to cover a catastrophic loss or to be taken out in cash when you stop writing options. In a recent consultation with a professional option writer, I recommended that he send 10% of his profit above a certain threshold to the bank that holds the mortgage on his country house, using that prepayment as his insurance fund. Can option buying be intelligent? Professionals may buy puts on a rare occasion when they expect a severe drop. When a long-term uptrend begins to turn, it can create massive turbulence near the top, similar to an ocean liner changing its course. When volatility goes through the roof, even well-heeled traders have trouble setting stops on shorts. Buying puts allows you to sidestep this problem. Prices tend to fall twice as fast as they rise. Greed, the dominant emotion of uptrends, is a happy and lasting feeling. Fear, the dominant emotion of downtrends, is sharper and more violent. Professionals are more likely to buy puts because of shorter exposure to time decay. Uptrends are better traded with stocks or futures. A trader who expects a downswing must decide what put to buy. The best choice is counterintuitive and quite different from what most people get. Estimate how low you expect a stock to collapse. A put is worth buying only if you expect a crash. Avoid puts with more than 2 months of life. Buying puts makes sense only when you expect a waterfall decline. If you anticipate a drawn-out downtrend, better sell short the underlying security. Look for cheap puts whose price reflects no hope. Move your finger down the column, the lower the strike, the cheaper the put. At first, each time you drop to the next strike price, a put is 25% or even 35% cheaper than at the previous level. Eventually, you come to the strike level at which you would save only a tiny fraction of a put's price. This shows that all hope has been squeezed out of that put, and it is priced like a cheap lottery ticket. That's the one you want. Buying a very cheap, far out of the money put is counterintuitive. It is so far out of the money and has so little life left in it that it's likely to expire worthless. You can't place a stop on it, and if you're wrong, the entire premium will go up in smoke. Why not buy a put closer to the money? The only time to buy a put is when you're shooting for an exceptional gain from a major reversal. In an ordinary downtrend, it's better to short stocks. With cheap far out of the money puts you aim for a tenfold gain or better. Returns like these allow you to be wrong on a string of such trades, yet come out ahead in the end. Catching one major reversal will make up for several losses and leave you very profitable. Why don't more people use this tactic? First, it requires a great deal of patience as opportunities are very infrequent. The entertainment value is very low. Most people can't stomach the idea of being wrong 3, 4, or 5 times in a row, even if they are likely to make money in the end. That's why so few traders play this game. I wrote this chapter to sharpen your focus on some of the key options ideas. If interested in options, study Lawrence Macmillan's book Options as a Strategic Investment. 45. CFDs. A contract for difference CFD is a bet on the future value of a currency, an index, or a stock. If you buy a CFD and the price of the underlying vehicle rises, you'll collect the difference from the company that sold you the contract. But if it falls, you'll pay the difference. CFDs are derivatives that allow speculators to bet on rallies or declines. They are similar to spread betting, which is legal in the United Kingdom and Ireland, but not in the United States. At the time of this writing, CFDs are available in Australia, Canada, France, Germany, Hong Kong, Ireland, Italy, Japan, the Netherlands, New Zealand, Norway, Poland, Portugal, Singapore, South Africa, Spain, Sweden, Switzerland, and the United Kingdom. They are prohibited in the United States due to restrictions by the Securities and Exchange Commission. CFDs were invented in the early 1990s by Brian Keelan and John Wood, both of UBS Warburg in London. Institutional traders began using them to hedge stock exposure and to avoid taxes. In the late 1990s, several firms began marketing CFDs to retail traders, touting their leverage and the exemption from UK taxes. Several provider firms expanded their offerings from the London Stock Exchange to global stocks, commodities, bonds, and currencies. Index CFDs, based on the major global indexes such as Dow Jones, S&P 500, FTSE, and DAX, quickly became the most popular vehicles of the group. CFDs are contracts between individual traders and providers, who may offer different deal terms. Each CFD is created by opening a trade with a provider, based on some underlying instrument. Be prepared to pay large bid-ask spreads, commissions, and overnight financing. Trades are mostly short-term, although positions can be taken overnight. Financing charges and profits or losses are credited or debited daily. CFDs are traded on margin. Among the pluses of CFDs are the tiny minimum sizes of those contracts, making them accessible to small traders. The absence of the expiration dates means there is no time decay. While financing is charged on long positions, it is paid out on short positions. There are several serious misgivings about the CFDs. Commissions tend to be high relative to contract sizes. Bid-ask spreads are controlled by CFD issuers, who also control prices of contracts, which may deviate from prices of the underlying securities. In other words, a retail customer plays against a professional team that can move the goalposts during the game. A client from New Zealand wrote, "Regarding CFDs and spread betting, it is worth understanding that with CFDs you are not just trying to beat the market but the casino too. CFD providers can set whatever prices they like for an instrument, as it is their instrument. The fact that sometimes it emulates what happens in the stock market does not mean it is the same as trading in the stock market. CFDs are heavily marketed to new and inexperienced traders, extolling their potential gains while glossing over risks. The Australian financial regulator ASIC considers trading CFDs riskier than gambling on horses or in casinos. CFDs are banned in the United States, where regulators haven't forgotten the bucket shops that flourished at the turn of the 20th century. The stance of the SEC in this matter reminds me of another federal agency, the Food and Drug Administration, which kept thalidomide, a drug for pregnant women, out of the United States. As a result, after the full scale of its horrible side effects became known, the U.S. population was spared an epidemic of deformed babies that was caused by that drug in Europe. 46. Futures. A future is a contract for delivery of a specific quantity of a commodity by a certain date at an agreed-upon price. Futures contracts differ from options by being binding on both the buyer and the seller. In options, the buyer has the right but not an obligation to take delivery. If you buy a call or a put, you can walk away if you like, but in futures, you have no such luxury. If the market goes against you, you have to get out of your trade at a loss or add to your margin. Futures are stricter than options, but their responses to market volatility are much smoother, making them easier to trade. Another advantage of futures is that there are only a few dozen of them, making them easier to track. Futures are not nearly as correlated with each other as stocks. While stocks tend to move as a group, many futures move in unrelated trends, offering more trading choices. Commodities are the irreducible building blocks of the economy. Wheat is a commodity, while bread isn't because it includes multiple components. Old-timers used to joke that a commodity was something that hurt when you dropped it on your foot: gold, sugar, wheat, a barrel full of crude oil. In recent decades, many financial instruments began to trade like commodities: stock indexes, bonds, and currencies. Futures include financial instruments along with traditional commodities. The person who buys a stock becomes a part owner of a company, but when you buy a futures contract, you don't own anything. You enter into a binding contract for a future purchase of merchandise, be it a carload of wheat or a sheaf of treasury bonds. The person who sells you that contract assumes the obligation to deliver. The money you pay for a stock goes to the seller, but in futures, your margin money stays at the clearinghouse as a security to ensure you'll accept delivery when your contract comes due. That's why they used to call margins honest money. While in stocks you pay interest for margin borrowing, in futures you can collect interest on your margin funds. Each futures contract has a definite size and a settlement date. Most traders close out their contracts early, settling profits and losses in cash. Still, the existence of a delivery date forces people to act, providing a reality check. A person may sit on a losing stock for years, deluding himself that it's only a paper loss. In futures, reality, in the form of the settlement date, always intrudes on a daydreamer. Most futures have daily limits beyond which prices are not allowed to go. Limits are designed to interrupt hysterical moves and give people time to rethink their positions. A string of limit days can be very stressful when a losing trader is stuck, and unable to get out while his account is being ground down. The globalization of the futures markets has created many emergency exits, allowing you to unwind a trade elsewhere. Just like when boarding a plane, a careful trader learns to identify those emergency exits before he needs them. In stocks, most people buy and very few sell short. In futures, just like in options, the size of long and short positions is always equal because if someone buys a contract for future delivery, someone else has to sell it to him, i.e., go short. If you want to trade futures, it pays to be comfortable shorting. The survival rate for new futures traders is low. 9 out of 10 newcomers are said to bust out in the first few months. It is important to understand that the danger is not in futures, but in a gross lack of risk management skills among beginners. Futures offer some of the best profit opportunities to serious traders, but are deadly for amateurs. You must develop excellent money management skills, described in chapters 49-51, before venturing into futures. Futures and cash trades. To compare a futures trade with a cash trade, let's assume the following. It is February. Gold is trading at $1,500 an ounce, and your analysis indicates that it's likely to rise to $1,575 within weeks. With $150,000, you can buy a 100 Oz gold bar from a dealer and store it in a safe. If your analysis is correct, in a few weeks your gold will be worth $157,500. You can sell it and take $7,500 profit, or 5% before commission's nice. Now let's see what happens if you trade futures based on the same analysis. Since it is February, April is the next delivery month for gold. One futures contract covers 100 Oz of gold, with a value of $150,000. The margin to trade this contract is only $7,500. In other words, you can control $150,000 worth of gold with a $7,500 deposit. If your analysis is correct and gold rallies $75 per ounce, you'll make roughly the same profit as when you bought 100 Oz of gold for cash. Only now your return will be 100% on your investment instead of 5%, since your margin is only $7,500. Many people, after seeing such numbers, feel a surge of greed and buy multiple contracts. A trader with $150,000 in his account has enough margin for 20 contracts. If he can double his money on a single contract, he can double it on 20. If he repeats it 2 or 3 times, he'll quickly become a millionaire. Wonderful, but there is a catch. Markets seldom move in a straight line. Your analysis may well be correct and gold may rise from $1,500 to $1,575 within a few weeks, but it's perfectly possible that it may dip to $1,450 along the way. That $50 dip would create a $5,000 paper loss if you bought 100 Oz of gold for cash. Unpleasant, but not a tragedy. For a futures trader who bought multiple contracts, each on a $7,500 margin, that $50 decline would mean a wipeout. His broker would call demanding more margin, and if he has no reserves, the broker will sell him out at a loss. Inexperienced traders keep buying too many contracts and keep getting kicked out by the first wiggle of their market. Their analysis may be correct. Gold may rise to its target price, but the beginner is doomed because he commits too much of his equity and has very thin reserves. Futures don't kill traders. Poor money management kills futures traders. Futures can be very attractive for traders with strong money management skills. High rates of return demand ice-cold discipline. A beginner is better off with slower-moving stocks. Once you've matured as a trader, you can take a closer look at futures. Also, read some introductory books. Winning in the Futures Market by George Angel is a good primer, to be followed by The Futures Game by Toohls and Jones. Hedging. Futures markets serve an important economic function. They permit commercial producers and consumers to hedge commodity price risks, giving them a competitive advantage. At the same time, futures offer speculators a gambling palace with more choices than any casino. Hedging means opening a futures position opposite to one's position in the actual commodity. For example, a major candy manufacturer knows months in advance how much sugar the firm is going to need. He buys a corresponding number of sugar futures in New York or London when prices are good enough for the firm. They'll be needing trainloads of sugar several months from now, but meanwhile they hold sugar futures, which they plan to sell when they buy their cargoes. If sugar prices go up and they have to pay more for the raw commodity, they will offset that loss by making roughly the same profit on their futures position. If sugar prices fall, they'll lose money on their futures contracts, but make it up in savings on the raw materials. Their unhedged competitors are taking chances. If sugar prices fall, they'll buy on the cheap and reap a windfall, but if prices rise, they'll be hung out to dry. Hedged consumers can concentrate on running their core businesses, insulated from future price swings. Airlines know years in advance how much jet fuel they'll need, and buying oil futures protects them from price spikes that often occur in this volatile market. Producers of commodities also benefit from hedging. An agribusiness can presell its wheat, coffee, or cotton when prices are high enough to assure profits. They sell short enough futures contracts to cover the size of their prospective crop. From that point on, they have no price risk. If prices go down, they'll make up their losses on cash commodity by profits on short futures trades. If prices go up, they'll lose money on their short futures positions but make it back selling the actual commodity at higher prices. Hedging removes price risk from planning to buy or to deliver a cash commodity. It allows commercial interests to concentrate on their core businesses, offer stable consumer pricing, and obtain a long-term competitive advantage. Hedgers give up a chance of a windfall but insulate themselves from price risks. Survivors value stability. That's why the Exxons, the Coca-Colas, and the Nabiscos of the world are among the major players in commodity markets. Hedgers are the ultimate insiders, and a good hedging department not only buys price insurance, but also serves as a profit center. Hedgers transfer price risks to speculators who enter the markets, lured by the glitter of potential profits. It's ironic that hedgers, who have inside information, are not fully confident about prices, while crowds of cheerful outsiders plunk down money to bet on futures. The two largest groups of speculators are farmers and engineers. Farmers produce commodities, while engineers love to apply scientific methods to the futures game. Many farmers enter futures markets as hedgers but catch the bug and start speculating. It never ceases to amaze me how many farmers end up trading stock index futures. As long as they trade corn, cattle, or soybeans, their feel for the fundamentals gives them an edge over city slickers. But what's their edge in the S&P 500? Supply, demand, and seasonality. Major bull and bear markets in futures are driven by supply or demand. Supply-driven markets tend to be fast and furious, while demand-driven markets tend to be quiet and slow. Why? Think of any commodity, say coffee, which grows in Africa and South America. Changes in demand come slowly, thanks to the conservatism of human nature. The demand for coffee can increase only if drinking becomes more popular, with an espresso machine in every bar. The demand can fall off if coffee drinking becomes less popular due to a deteriorating economy or in response to a health fad. Demand-driven markets move at a leisurely pace. Now imagine that a major coffee-growing area is hit by a hurricane or a freeze. Suddenly, the world supply of coffee is rumored to be reduced by 10% and prices shoot up, cutting off marginal consumers. Imagine a new OPEC policy sharply curtailing crude oil supply or a general strike in a leading copper mining country. When a commodity supply is reduced, or even rumored to be reduced, its price climbs, reallocating tight supplies to those best able to afford them. Grain prices often spike during spring and summer planting and growing seasons, as dry spells, floods, and pests threaten supplies. Traders say that a farmer loses his crop 3 times before harvesting it. Once the harvest is in and the supply is known, demand becomes the driving force. Demand-driven markets have narrower channels, with smaller profit targets and lower risks. As seasons change, channels have to be redrawn and trading tactics adjusted. A new trader may wonder why his tools stopped working. A smart trader gets out a new set of tools for the season and puts old ones in storage until next year, just as he swaps regular and snow tires on his car. A futures trader must know the key supply and demand factors of the market he's trading. For example, he must keep an eye on the weather during the critical growing and harvesting months in agricultural commodities. Trend traders in the futures markets tend to look for supply-driven markets, while swing traders can do just as well in demand-driven markets. Most commodities fluctuate through the seasons. Freezing spells in the United States are bullish for heating oil futures. Orange juice futures used to have wild run-ups during the frost season in Florida, but have become much more sedate due to the increase of orange production in Brazil in the southern hemisphere. Seasonal trades take advantage of such swings, but you have to be careful because those cycles are seldom identical. Be sure to put your seasonal trades through the filter of technical analysis. Floors and ceilings. Commodities, unlike stocks, rarely trade below certain price floors or above price ceilings. The floor depends on the cost of production. When the price of a commodity, be it gold or sugar, falls below that level, miners stop digging and farmers stop planting. Some third-world governments, desperate for dollars and trying to avoid social unrest, may subsidize production, paying locals in a worthless local currency and dumping their product on the world market. Still, if enough producers close up and quit, the supply will shrink, and prices will have to rise to draw in new suppliers. If you look at a 20-year chart of most commodities, you'll see that the same price areas have served as a floor year after year. The ceiling depends on the cost of substitution. If the price of a commodity rises, major industrial consumers will start switching away from it. If soybean meal, a major animal feed, becomes too expensive, the demand will switch to fish meal, and if sugar becomes too costly, the demand will switch to corn sweeteners. Why don't more people trade against those levels? Why don't they buy near the floor and short near the ceiling, profiting from what is similar to shooting fish in a barrel? First of all, neither the floor nor the ceiling is set in stone, and markets may briefly violate them. Even more importantly, the human nature works against those trades. Most speculators don't have the courage to short a market that's boiling near record highs or go long a market after it has crashed. Contango, inversion, and spreads. All futures markets offer several contracts for different delivery months. For example, you can buy or sell wheat for delivery in September or December of this year, March of next year, and so on. Normally, the nearby months are cheaper than the remote ones, and that relationship is called a contango market. Higher prices for more remote deliveries reflect the cost of carry, financing, storing, and insuring a commodity. The differences between delivery months are called premiums, and hedgers closely watch them. When supply tightens or demand increases, people start paying up for the nearby months, and the premium for the faraway months begins to shrink. Sometimes the front months become more expensive than faraway months. The market becomes inverted. There is a real shortage out there, and people are paying extra to get their stuff sooner. This so-called inversion is one of the strongest signs of a bull market in a commodity. When you look for inversions, keep in mind that there is one market in which inversion is the norm. Interest rate futures are always inverted because those who hold cash positions keep collecting interest instead of paying finance and storage charges. Professionals don't wait for inversions, they monitor the narrowing or widening of premiums. A good speculator can rattle off the latest prices, but a floor trader will quote you the latest premiums. A savvy trader knows by heart the normal spreads between different delivery months. Hedgers tend to dominate the short side of the markets. Most speculators are perpetual bulls, but floor traders love to trade spreads. Spreading means buying one delivery month and selling another in the same market. It also means going long one market while shorting a related one. If the price of corn, a major animal feed, starts to rise faster than the price of wheat, at some point ranchers will start using wheat rather than corn. They'll reduce their purchases of corn while buying more wheat, pushing their spread back towards the norm. Spread traders bet against deviations and for a return to normalcy. In this situation, a spreader will short corn and buy wheat instead of taking a directional trade in either market. Spread trading is safer than directional trading and has lower margin requirements. Amateurs do not understand spreads and have little interest in these reliable but slow-moving trades. There is not a single book on spreads I can recommend, a sign of how well professionals have sewn up this area of knowledge and kept the outsiders out. This is one of a handful of niches in the markets where professionals are earning high incomes without the benefit of a single good how to book. Commitments of traders. Brokers report their clients' positions to the Commodity Futures Trading Commission, CFTC, which strips away personal data and releases summaries to the public. Their commitments of traders, COT reports, are among the best sources of information on what the smart money is doing in the futures markets. COT reports reveal positions of three groups: hedgers, big traders, and small traders. Hedgers identify themselves to brokers because that entitles them to several advantages, such as lower margin deposits. Big traders are those who hold the number of contracts above the reporting requirements set by the government. Whoever is not a hedger or a big trader is a small trader. In the old days, big traders used to be the smart money. Today, the markets are bigger, the reporting requirements much higher, and big traders are likely to be commodity funds, most of them not smarter than run-of-the-mill traders. The hedgers are today's smart money, but understanding their positions isn't as easy as it seems. For example, a COT report may show that in a certain market, hedgers hold 70% of shorts. A beginner who thinks this is bearish may be completely off the mark if he doesn't know that normally hedgers hold 90% of shorts in that market, making the 70% stance wildly bullish. Savvy COT analysts compare current positions to historical norms and look for situations where hedgers, or the smart money and small traders, many of whom are gamblers, are dead set against each other. If you find that in a certain market, the smart money is overwhelmingly on one side, while the small specs are mobbing the other, it is time to use technical analysis to look for entries on the side of hedgers. Margins and risk control. Futures' low margin requirements make them more rewarding than stocks, but also much more dangerous. When buying stocks in the United States, you must put up at least half of their cash value with the broker giving you a margin loan for the rest. If you have $40,000 in your account, you may buy $80,000 worth of stocks, and no more. This margin limit was implemented after the crash of 1929, when it became clear that low margins led to excessive speculation, which contributed to the viciousness of declines. Prior to 1929, speculators could buy stocks on a 10% margin, which worked great in bull markets but forced them to liquidate when prices slid, pushing the market lower during bear markets. Margins of only 3 to 5% are common in the futures markets, allowing traders to make huge bets with little money. With $40,000 in your account, you may control about $1 million worth of merchandise, be it pork bellies or stock index futures. For example, if gold trades at $1,500 Oz and you buy a 100 Oz contract on a $7,500 margin and catch a $75 price move, you'll gain 100%. A beginner looks at these numbers and exclaims, "Where have I been all my life?" He thinks he's found a royal road to riches, but there is a catch. Before that market rises $75, it may dip $50. That meaningless blip will trigger a margin call and force a small speculator's account to go bust, despite his correct forecast. Easy margins attract adrenaline junkies who quickly go up in smoke. Futures are very tradable, but only if you follow strict money management rules and don't go crazy with easy margins. Professionals put on small initial positions and pyramid them if a trade moves in their favor. They keep adding new contracts while moving stops beyond break-even. When you become interested in futures, it's a good idea to make your first steps in those markets where you know something about the fundamentals. If you are a cattle rancher, a house builder, or a loan officer, then cattle, lumber, or interest rate futures would be logical starting points. If you have no particular interests, make your first steps in relatively inexpensive markets. In the United States, corn, sugar, and in a slow year, copper can be good markets for beginners. They are liquid, volatile, and not too expensive. We'll return to the futures markets in Part 9, Risk Management. There you'll find which contracts you may or may not trade, depending on their price and volatility as well as your account size. Futures traders with small accounts sometimes trade mini contracts. For example, a regular contract of gold represents 100 Oz of the yellow metal, but a mini contract covers only 20 Oz. Mini contracts trade during the same hours as regular contracts and closely track their prices. Their commissions are similar to those for regular contracts, taking a proportionately bigger bite from each trade. Their slippage tends to be bigger due to lower volumes. The exceptions are stock index futures, where mini contracts have higher volumes than regular ones. 47. Forks. The currency market is the largest asset class in the world by trading volume, with a turnover of over $4 trillion per day. Currencies trade around the clock, from 2015 GMT on Sunday to 22 GMT on Friday, stopping only on weekends. While some currency trades serve the hedging needs of importers and exporters, most transactions are speculative. The United States is the only country in the world where most people don't think much about currencies. The moment an American sets foot abroad, he realizes that everyone, from executives to taxi drivers, watches the exchange rates. When people outside the United States get their hands on a bit of trading capital, often their first idea is to trade forks. The forex market has no central location. Institutions deal in the interbank market, trading with each other using online platforms, such as Bloomberg or Reuters. Unless you can trade $10 million of spot forks at a pop, you'll be trading retail, going through a broker. Most beginners open accounts at forex shops where they immediately run into a fatal flaw. Your broker is your enemy. When you trade stocks, futures, or options, your broker is your agent. He executes your trades for a fee, and that's the end of it. Not so in most forex as well as CFD houses, where your broker is likely to take the opposite side of every trade. You and the forex house are now against each other. If you lose, your broker will profit, and if you win, he'll lose. Since the house holds most of the cards, it has many ways to achieve the desired result. Most forex houses bucket customer orders, accept them without executing any trades. They charge spreads, commissions, interest, etc. for non-existent trades. I received the clearest explanation of their game from a chatty head dealer at a major European forex house, which is now expanding worldwide with branches in the United States. I see their billboards in New York. That forex house accepts any trade in any currency pair, whether long or short, but always shifts the bid-ask spread to put itself at an advantage from the get-go. Those so-called trades never go anywhere. They're only kept as electronic entries in the firm's books. The forex house charges interest if its customers take their phantom positions overnight, even though there is never any position, since the house simply holds the opposite side of each trade. The only time the firm goes to the legitimate market is when multiple client orders cluster on the same side of the same currency pair, in excess of $1 million. That's when the house hedges its own exposure in the real market. When you trade stocks, options, or futures, your broker buys or sells on your behalf, earning a commission for this service, and doesn't care whether you win or lose. This is great, because he has no incentive to push you into losing. On the other hand, a forex house that buckets your orders wants you to lose, so that it can win. In addition to shifting bid-ask spreads and charging interest on non-existent positions, it may even charge a daily resettlement fee, the full bid-ask spread for every day you hold a trade. Forex shops help ensure their clients' demise by offering homicidal leverage. I've seen them offer leverage of 1,001 and even 4,001. A newcomer who scrapes together a $1,000 stake can suddenly control a position worth $100,000. This means that the slightest price wiggle against him is guaranteed to wipe out his equity. That's why those shops confidently keep clients' money in-house, never transmitting their trades to the real market. Why share the loot with anyone else? They are so certain of their clients' demise that many compensate employees with a percentage of the client deposits that they bring in. Funds deposited with a forex house are as good as theirs. The market has long been plagued by swindlers preying on the gullible, according to the New York Times. The average individual foreign exchange trading victim loses about $15,000, according to CFTC records, writes the Wall Street Journal. Currency trading has become the fraud du jour, according to Michael Dunn of the U.S. Commodity Futures Trading Commission. In August 2008, the CFTC set up a special task force to deal with growing foreign exchange fraud. In January 2010, the CFTC identified a number of improper practices in the retail foreign exchange market, among them solicitation fraud, a lack of transparency in the pricing and execution of transactions, unresponsiveness to customer complaints, and the targeting of unsophisticated, elderly, low net worth, and other vulnerable individuals. It proposed new rules limiting leverage to 10-to-1. Frauds may include churning customer accounts, selling useless software, improperly managing managed accounts, false advertising, and Ponzi schemes. All the while, promoters claim that trading foreign exchange is a road to profits. The real forex market is a zero-sum game in which well-capitalized professional traders, many of whom work for banks, devote full-time attention to trading. An inexperienced retail trader has a significant information disadvantage. The retail trader always pays the bid-ask spread, which lowers his odds of winning. Retail forex traders are almost always undercapitalized and subject to the problem of gambler's ruin. Even in a fair game between two players, the one with the lower amount of capital has a higher probability of going bust in the long run. Having observed forex shops for decades, I was amused to see what my best student did when he became interested in forex. This multimillionaire stock trader decided to check out forex houses by opening large accounts and then waiting for the night, when forex trading was at its thinnest. That's when he placed his orders, always of a very unusual and atypical size, and watched the tape. There were only 2 houses that showed his orders on tape. The rest apparently got bucketed. I enjoy trading currencies but wouldn't go near a forex house. Instead, I trade electronic currency futures. That's what I recommend to anyone interested in trading foreign exchange. Futures brokers work for you, not against you. Futures spreads are more narrow, commissions more reasonable, and no interest is charged for the privilege of holding a position. There are contracts for most major currency pairs, and even mini-contracts for euro-dollar and yen-dollar. One of the real challenges of currencies is that they move around the clock. You may enter a trade, analyze it in the evening, and decide to take profits the following day. When you wake up, there are no profits to be taken. The turning point you saw coming has already come and gone, only not in the United States, but in Asia or Europe. Someone had picked your pocket while you slept. Major financial institutions deal with this problem by using the system of passing the book. A bank may open a position in Tokyo, manage it intraday, and then transfer it to its London branch before closing for the night. London continues to manage that and other positions, and in the evening passes the book to New York, which manages it until it passes it back to Tokyo. Currencies follow the sun, and small traders can't keep up with it. If you trade currencies, you either need to take a very long-term view and ignore daily fluctuations, or else day trade and avoid overnight positions. Part 9. Risk Management. A good trading system delivers greater profits than losses over a period of time, but even the most carefully designed system doesn't guarantee success in every trade. No system can assure you of never having a losing trade or even a series of losing trades. System is a plan, but as Helmuth von Moltke, a 19th-century German field marshal, wrote, "No plan survives contact with the enemy." The U.S. boxer Mike Tyson, quoted by The Economist, put it more bluntly, "Everyone has a plan till they get punched in the mouth." This is why risk control must be an essential part of every trading system. The inability to manage losses is one of the worst pitfalls in trading. Beginners freeze like deer in the headlights when a deepening loss starts wiping out profits of many good trades. It's a general human tendency to take profits quickly but wait for losing trades to come back to even. By the time the despairing amateur gives up hope and closes his trade with a terrible loss, his account is badly and sometimes irreparably damaged. To be a successful trader, you need to learn risk management rules and firmly implement them. 48. Emotions and probabilities. Money stirs up powerful feelings. The emotional storms, raised by making or losing money, hit our trading. A beginner rushing to place an order may feel giddy with the excitement. He will soon find out that the market offers a painfully expensive form of entertainment. Early in my career, I heard from a professional trader that successful trading should be a little bit boring. He spent long hours each day doing homework, sifting through market data, calculating risks, and maintaining records. Those time-consuming tasks weren't exciting, but his success was built on such grunt work. Beginners and gamblers get a full load of entertainment, but pay for it with losses. Another emotional mistake is counting money in open trades. Newbies dream about what they can buy with open profits or freeze from the shock of comparing open losses to their paychecks. Thinking about money interferes with decision-making. Professionals focus on managing trades. They count money only after those trades are closed. A trader who counts profits in an open trade is like a lawyer who, in the middle of a trial, starts dreaming of what he'll buy with his fee. That trial is still going on. His opponents are building a case against his client, and counting money will not help him win. Quite the contrary, it'll distract him and cause him to lose. An amateur who becomes upset counting losses in an open trade is like a surgeon who throws a tray of instruments after the patient on the table starts bleeding. His frustration will not improve the outcome of the case. Professional traders don't count money in open trades. They do it at the end of an accounting period, such as a month. If you were to ask me about an open trade, I could answer that it's a bit ahead, a lot ahead, or a bit behind, a lot behind is unlikely because of my stops. If you were to press me for a number, I might tell you how many ticks I'm ahead or behind, but I'll never translate those ticks into dollars. It took me years to train myself to break the destructive habit of counting money in open trades. I can count ticks, but my mind stops before converting them into dollars. It's like being on a diet. There is plenty of food around, but you don't touch it. Focus on managing your trade and the money will follow almost as an afterthought. Another key point: a professional doesn't get worked up about his wins or losses in a single trade. There is a great deal of randomness in the markets. We can do everything right and still end up with a losing trade, just like a surgeon can do everything right and still lose a patient. That's why a trader should care only about having a method with a positive expectation and work on being profitable at the end of his accounting period. The goal of a successful professional in any field is to reach his personal best, to become the best doctor, the best lawyer, or the best trader. Handle each trade like a surgical procedure, seriously, soberly, without sloppiness or shortcuts. Concentrate on trading right. When you work this way, money will come later. Why Johnny can't sell. Your survival and success depend on your willingness to cut losses while they're relatively small. When a trade starts going against a beginner, he hangs on, hoping for a reversal in his favor. When he gets a margin call, he scrambles to send more money to the broker, as if the initial loss hadn't been bad enough. Why should a losing trade turn in his favor? There's no logical reason, only wishful thinking. Stubbornly holding a losing trade only deepens the wound. Losses have a way of snowballing until what initially seemed like a bad loss starts looking like a bargain because the current drawdown is so much worse. Finally, a desperate loser bites the bullet and closes out a trade, taking a severe loss. Right after he exits, the market reverses and comes roaring back. The trader is ready to smash his head against a wall. Had he hung on, he would have made money. Such reversals happen time and again because most losers respond to the same stimuli. People have similar emotions, regardless of their nationality or education. A frightened trader with sweaty palms and a pounding heart feels and acts the same way, whether he grew up in New York or Hong Kong, and whether he had 2 or 20 years of schooling. The intellectual demands of trading are modest, but its emotional demands are immense. Many years ago, a highly educated but very emotional trader showed me how to trade divergences near channel walls. I fine-tuned his method, added risk management rules, and continue to make money with it to this day. The man who taught me had busted out because of his lack of discipline and ended up going door to door, selling aluminum siding. Emotional trading and impulsivity are not good for success. Roy Shapiro, a New York psychologist from whose article the title of this subchapter is borrowed, writes, "With great hope, in the private place where we make our trading decisions, our current idea is made ready. One difficulty in selling is the attachment experienced toward the position. After all, once something is ours, we naturally tend to become attached to it. This attachment to the things we buy has been called the endowment effect by psychologists and economists, and we all recognize it in our financial transactions as well as in our inability to part with that old sports jacket hanging in the closet. The speculator is the parent of the idea. The position takes on meaning as a personal extension of self, almost as one's child might. Another reason that Johnny does not sell, even when the position may be losing ground, is because he wants to dream. For many, at the moment of purchase, critical judgment weakens and hope ascends to govern the decision process. Dreaming in the markets is a luxury we can't afford. Dr. Shapiro describes a test that shows how people conduct business involving a chance. First, a group of people are given a choice, a 75% chance to win $1,000 with a 25% chance of getting nothing or a sure $700. 4 out of 5 subjects take the second choice, even after it is explained to them that the first choice leads to a $750 gain over time. The majority makes the emotional decision and settles for a smaller gain. Another test is given. People have to choose between a sure loss of $700 or a 75% chance of losing $1,000 and a 25% chance of losing nothing. 3 out of 4 take the second choice, condemning themselves to lose $50 more than they have to. In trying to avoid risk, they maximize losses. Emotional traders crave certain gains and turn down profitable wagers that involve uncertainty. They go into risky gambles to postpone taking losses. It is human nature to take profits quickly and losses slowly. The irrational behavior increases when people feel under pressure. According to Dr. Shapiro at the racetrack, bets on long shots increase in the last 2 races of the day. Prof. Daniel Kahneman writes in his book Thinking, Fast and Slow, "The sure loss is very aversive, and this drives you to take the risk. Considerable loss aversion exists even when the amount at risk is minuscule relative to your wealth. Losses loom larger than corresponding gains." He adds, "Animals, including people, fight harder to prevent losses than to achieve gains," and spells it out. People who face very bad options take desperate gambles, accepting a high probability of making things worse in exchange for a small hope of avoiding a large loss. Risk-taking of this kind often turns manageable failures into disasters. Why do we act this way? Prof. Kahneman explains. Except for the very poor, for whom income coincides with survival, the main motivators of money-seeking are not necessarily economic. Money is a proxy for points on a scale of self-regard and achievement. These rewards and punishments, promises and threats, are all in our heads. Emotional trading destroys losers. A review of trading records usually shows that the worst damage was done by a few large losses or a long string of losses while trying to trade one's way out of a hole. The discipline of good money management would have kept us out of that hole in the first place. Probability and innumeracy. Numeracy, the inability to count or understand the basic notions of probability, is a fatal weakness for traders. The counting skills aren't hard, can be picked up from many basic books, and then sharpened with some practice. The lively book Innumeracy by John Allen Paulos is an excellent primer on the concepts of probability. Paulos describes being told by a seemingly intelligent person at a cocktail party, "If the chance of rain is 50% on Saturday and 50% on Sunday, then it is 100% certain it will be a rainy weekend." Someone who understands so little about probability is sure to lose money trading. You owe it to yourself to develop a grasp of the basic mathematical and logical concepts involved in trading. There are very few ironclad certainties in market analysis, which is largely based on probabilities. If the signals A and B are present, then the outcome C will occur is not the kind of logic that holds up in the markets. Ralph Vince begins his important book Portfolio Management Formulas with this delightful paragraph. Toss a coin in the air. For an instant you experience one of the most fascinating paradoxes of nature, the random process. While the coin is in the air, there is no way to tell for certain whether it will land heads or tails. Yet over many tosses, the outcome can be reasonably predicted. Mathematical expectation is an important concept for traders. Each trade has either a positive expectation, also called the player's edge, or a negative expectation, also called the house advantage, depending on who has better odds in a game. If you and I flip a coin, neither of us has an edge, each has a 50% chance of winning. If you play the same game in a casino that takes 5% from every pot, you'll win only 95 cents for every dollar you lose. This house advantage will create a negative mathematical expectation. No system for money management can beat a negative expectation over a period of time. A positive expectation. A skilled card counter has an edge against a casino unless they detect him and throw him out. Casinos love drunken gamblers but hate card counters. An edge lets you win more often than lose over a period of time. Without an edge, you might as well give money to charity. In trading, the edge comes from systems that deliver greater profits than losses after slippage and commissions over a period of time. Acting on hunches leads to losses. The best trading systems are simple and robust. They have very few elements. The more complex the systems, the higher the risk that some of its components will break. Traders love to optimize systems, making them fit past data. The trouble is, your broker won't let you trade in the past. Markets change, and indicator parameters that would have nailed the trends last month are unlikely to nail them a month from now. Instead of optimizing your system, try to optimize it. A robust system holds up well to market changes and beats a heavily optimized system in real trading. Finally, once you develop a good system, stop messing with it. If you like to tinker, design another system. As Robert Prichter put it, most traders take a good system and destroy it by trying to make it into a perfect system. Once you have a trading system that works, it's time to set the rules for money management. You can win only if you have a positive mathematical expectation from a sensible trading system. Money management will help you exploit a good system, but cannot rescue a bad one. Businessman's risk or loss. We analyze markets in order to identify trends. Be careful not to become overconfident when anticipating future prices. The future is fundamentally unknowable. When we buy, expecting a rally, it is entirely possible that an unforeseen event may flip the market and send it down. Your actions in response to surprises will define you as a trader. A pro manages his trades, accepting what's called a businessman's risk. This means that the amount he risks exposes him to only a minor equity drop. A loss, on the other hand, may threaten an account's health and even survival. We must draw a clear line between a businessman's risk and a loss. That border is defined by the fraction of the account a trader puts at risk in a trade. If you follow the risk management rules described below, you'll accept only a normal businessman's risk. Violating a well-defined red line will expose you to dangerous losses. This time is different, says an undisciplined trader. I'll give this trade a little extra room. The market seduces traders into breaking their rules. Will you follow yours? Once, I chaired a panel at a gathering of money managers at which one of the presenters had nearly $1 billion in his fund. A middle-aged man, he got into this business in his 20s, while working for a naval consulting firm after graduate school. Bored with his day job, he designed a trading system but couldn't trade it because it required a minimum of $200,000, which he didn't have in those days. I had to go to other people, he said, and ask them for money. Once I explained to them what I was going to do and they gave me money, I had to stick to my system. It would have been unconscionable to deviate from the system I told them I would follow. My poverty worked for me. Poverty and integrity. 49. The two main rules of risk control. If trading is a high wire act, then safety demands stringing a net underneath that wire. If we slip, the net will save us from getting smashed against the floor. The only thing better than a safety net is two safety nets. If one doesn't catch us as we fall, the other will. Even the best planned trades can go awry because of randomness in the markets. Even the best analyses and the clearest trade setups can't prevent accidents. What you can control is risk. You do it by managing the size of your trades and the placement of stops. This is how you keep the inevitable losses small, not allowing them to cripple your account, so that you can win in the long run. Ugly losses stick out like sore thumbs from most account records. Every performance review shows that a single terrible loss or a short string of bad losses did most of the damage to an account. Had a trader cut his losses sooner, his bottom line would have been much higher. Traders dream of profits but freeze when a losing trade hits them. If you follow risk management rules, you'll quickly get out of harm's way instead of waiting and praying for the market to turn. Markets can snuff out an account with a single horrible loss that effectively takes a person out of the game, like a shark bite. Markets can also kill with a series of bites, none of them lethal, but combined they strip an account to the bone, like a pack of piranhas. The two pillars of money management are the 2% and 6% rules. The 2% rule will save your account from shark bites and the 6% rule from piranhas, the two worst mistakes. There are two quick ways to ruin an account: not use stops and put on trades that are too large for that account size. Trading without stops exposes you to unlimited losses. In the following chapters, we'll discuss the principles and rules of risk control, but they will work only if you use stops. There are several methods for setting stops, and we'll discuss them in Chapter 54. We want to place our stops neither too far nor too close. At this point, just keep in mind that you must use stops. You have to know your maximum level of risk. It's as simple as that. If you don't know your maximum level of risk, you're flying blind. The other fatal error is overtrading, putting on trades whose size is too large for your account. This is like putting a huge sail on a small boat. A strong gust of wind will flip the boat over instead of making it go faster. People put on trades that are too large for their accounts out of ignorance, greed, or a combination of both. There is a simple mathematical rule that gives you the maximum size for every trade, as you are about to see. 50. The 2% rule. One disastrous loss can do to an account what a shark does to a hapless swimmer. A poor beginner who loses a quarter of his equity in a single trade is like a swimmer who just lost an arm or a leg to a shark and is bleeding into the water. He'd have to generate a 33% return on the remaining capital simply to come back to even. The chances of him being able to do that are slim to none. The typical victim of a shark bite loses more money. He loses confidence and becomes fearful of pulling the trigger. The way to avoid shark bite losses is by following the 2% rule. It will limit your losses to a manageable size, to a normal businessman's risk. The 2% rule prohibits you from risking more than 2% of your account equity on any single trade. For example, if you have $50,000 in your account, the 2% rule limits your maximum risk on any trade to $1,000. This is not the size of your trade. It's the amount you put at risk, based on the distance from your entry to your stop. Let's say you decide to buy a stock for $40 and put a stop at $38, just below support. This means you'll be risking $2 per share. Dividing your total permitted risk of $1,000 by your $2 risk per share tells you that you may trade no more than 500 shares. You are perfectly welcome to trade fewer shares. You don't have to go the max every time. If you feel very bullish about that stock and want to trade the maximum permitted size, that number of shares will be limited to 500. Good market analysis alone will not make you a winner. The ability to find good trades will not guarantee success. Markets are full of good analysts who destroy their accounts. You can profit from your research only if you protect yourself from sharks. I've seen traders make 20, 30, and once even 50 profitable trades in a row and still end up losing money. When you're on a winning streak, it's easy to feel you've figured out the game. Then a disastrous loss wipes out all profits and tears into your equity. You need the shark repellent of good money management. A good trading system will give you an edge in the long run, but in the short run, there is a great deal of randomness in the markets. The outcome of any single trade is close to a toss-up. A professional trader expects to be profitable by the end of the month or the quarter, but ask him whether he'll make money on his next trade and he'll honestly say he doesn't know. That's why he uses stops, to prevent negative trades from damaging his account. Technical analysis can help you decide where to place a stop, which will limit your loss per share. Money management rules will help you protect your account as a whole. The single most important rule is to limit your exposure on any trade to no more than 2% of your account. This rule applies only to money in your trading account. It doesn't include your savings, equity in your house, retirement account, or Christmas club. Your trading capital is the money you've dedicated to trading. This is your true risk capital, the equity in your trading enterprise. If you have separate trading accounts for stocks, futures, and options, apply the 2% rule to each account separately. I've noticed a curious difference in how people react when they first hear about the 2% rule. Newbies with small accounts often object that this number is too low. Someone asked me whether the 2% rule could be increased when he was feeling especially confident about a trade, and I answered that it would be like adding extra length to the cord for bungee jumping because you like the view from the bridge. Professionals, on the other hand, often say that 2% is too high and they try to risk less. You wouldn't want to lose 2% of $1 million on a single trade in one day. A hedge fund manager who consulted with me said that his project for the next 6 months was to increase his trading size. He never risked more than 0.5% of equity on a trade and was going to teach himself to risk 1%. Good traders tend to stay well below the 2% limit. Whenever amateurs and professionals are on the opposite sides of an argument, you know which side to choose. Try to risk less than 2%. It is simply the maximum level. Measure your account equity on the first day of each month. If you start the month with $100,000 in your account, the 2% rule allows you to risk a maximum of $2,000 per trade. If you have a good month and your equity rises to $105,000, then your 2% limit for the next month will be what? Quick. Remember, good traders can count. If you have $105,000 in your account, the 2% rule allows you to risk $2,100 and trade a slightly bigger size. If, on the other hand, you had a bad month and your equity fell to $95,000, the 2% rule will set your maximum permitted risk at $1,900 per trade for the following month. The 2% rule links the size of your trades to your performance as well as account size. The iron triangle of risk control. How many shares will you buy or sell short in your next trade? Beginners often choose an arbitrary number, such as 1,000 or 200 shares. They may buy more if they've made money in their latest trade or less if they've lost money. In fact, trade size should be based on a formula instead of vague gut feel. Use the 2% rule to make rational decisions on the maximum number of shares you may buy or sell short in any trade. I named this process the iron triangle of risk control, Figure 50.1. For example, when I volunteered to teach a year-long course, Money and Trading, in a local high school and wanted to make the experience real for the kids, I opened a $40,000 account. I told my students that if, at the end of the school year, we made money, I'd give half the profit to their school and distribute the rest among class participants. I also told them that their maximum risk per trade was 1%. A kid would stand up in class and make a case for buying Nokia at $16 with a stop at $14.50. How many shares may we trade? I'd ask. With the maximum risk of $400 per trade and $1.50 risk per share, the kids would be allowed to buy 250 shares, with some leeway for commissions. If you have a tiny account, you may end up trading the maximum permitted number of shares each time. As your account grows bigger, you may want to vary the size of your trades, say 1/3 of the maximum for regular trades, 2/3 for extra strong trades, and the full amount for exceptional trades. Whatever you do, the iron triangle of risk control will set the maximum number of shares you may trade. The 2% rule in the futures markets. A trader recently asked me how he could apply the iron triangle of risk control to trading E-mini futures in his $50,000 account. I replied, A. If you are trading a $50K account, the 2% rule would limit your risk on any trade to $1,000. Let's say you want to be conservative and risk only 1% of that account, or $500. That will be the first side of the iron triangle of risk control. B. Suppose you look at your favorite E-minis and want to sell a contract short at 18.10 with a profit target at 17.90 and a stop at 18.16. You'll be risking 6 points, and since 1 point in E-minis is worth $50, your total risk will be $300 plus commissions and possible slippage. That will be the second side of your iron triangle of risk control. C. Close the triangle by dividing A by B to find the maximum size you may trade. If your maximum risk is $500, then 1 contract, but if $1,000, then 3. Please meet 2 futures traders, Mr. Hare and Mr. Turtle, each with a $50,000 account. The agile Mr. Hare sees that the average daily range in gold is about $30, worth $3,000 per day for a single contract. The daily range in corn is about 10 cents, worth $500 per day for a single contract. He thinks that if he can catch just half of a day's range, he'll make $1,500 per contract in gold, while the same level of skill will bring him only $250 in corn. Mr. Hare logs into his brokerage account and buys 2 contracts of gold. The cautious Mr. Turtle has a different arithmetic. He begins by using the 2% rule to cap his maximum risk per trade at $1,000. He sees that it would be impossible to place a meaningful stop while trading gold, which can move $3,000 a day. To buy gold in his account would be like grabbing a very large tiger by a very short tail. If, on the other hand, he trades corn, he'll have good staying power. That tiger is smaller and has a longer tail, which he can wrap around his wrist. Mr. Turtle buys a contract of corn. Who do you think is more likely to win in the long run, Mr. Hare or Mr. Turtle? Futures markets are more deadly than stocks, not because of any special complexity. Sure, they have some specific angles, but those aren't too hard to learn. Futures kill traders by seducing them with paper-thin margins. They offer enormous leverage ability to trade large positions on a 5% margin. This works wonders when the market moves in your favor, but it slices your wallet when the market turns against you. You can succeed in futures only with sensible risk control, using the 2% rule. A. Calculate 2% of your account value. This will be the maximum acceptable risk level for any trade. If you have $50,000 in your futures account, the most you can risk is $1,000. B. Examine the charts of the market that interests you and write down your planned entry, target, and stop. Remember, a trade without these three numbers is not a trade but a gamble. Express the value of the move from your entry to your stop in dollars. C. Divide by B, and if the result turns out to be less than 1, no trade is permitted. It means you cannot afford to trade even one contract. Let's review two market examples, featuring similar chart patterns. Figure 50.2. Let's assume you have a $50,000 account, which permits you to risk the maximum of $1,000 per trade. You can trade futures reasonably safely, only with strict money management. The leverage of futures can work for you, as long as you stay away from those contracts that can kill your account. A professional futures trader surprised me early in my career when he told me he spent a third of his time on risk management. Beginners jump into trades without giving them much thought. Intermediate-level traders focus on market analysis. Professionals dedicate a massive proportion of their time to risk control and take money away from beginners and amateurs. If you cannot afford to trade a certain market, you can still download its data, do your homework, and paper trade it as if you were doing it with real money. This will prepare you for the day when your account grows big enough or the market grows quiet enough for you to put on a trade. 51. The 6% rule. A piranha is a tropical river fish not much bigger than a man's hand, but with a mean set of teeth. What makes it so dangerous is that it attacks in packs. If a dog, a donkey, or a person stumbles into a tropical stream, a pack of piranhas can attack with such a mass of bites that the victim collapses. A bull can walk into a river, be attacked by a pack of piranhas, and a few minutes later only its bones will be left in the water. A trader who keeps sharks at bay with the 2% rule still needs protection from piranhas. The 6% rule will save you from being nibbled to death. Most of us, when we find ourselves in trouble, start pushing harder. Losing traders often take on bigger positions, trying to trade their way out of a hole. A better response to a losing streak is to step aside and take time off to think. The 6% rule sets a limit on the maximum monthly drawdown in any account. If you reach it, you stop trading for the rest of the month. The 6% rule forces you to get out of the water before piranhas get you. The 6% rule prohibits you from opening any new trades for the rest of the month when the sum of your losses for the current month and the risks in open trades reach 6% of your account equity. We all go through periods when we are in tune with the markets, taking one profit after another. When everything we touch turns to gold, that's the time to trade actively. There are other times when everything we touch turns into a completely different substance. We go through periods when our systems go out of sync with the market, delivering one loss after another. It's important to recognize such dark periods and not push yourself, but rather step back. A professional on a losing streak is likely to take a break, continue to monitor the market, and wait to get in gear with it again. Amateurs are more likely to keep pushing until their accounts become crippled. The 6% rule will make you pause while your account is still largely intact. The concept of available risk. Before you put on a trade, ask yourself, what would happen if all your trades suddenly turned against you? If you use the 2% rule to set stops and trade sizes, the 6% rule will limit the maximum total loss that your account may suffer. 1. Add up all your losses taken this month. 2. Add up your risks on all currently open trades. The dollar risk of any open position is the distance from your entry to the current stop, multiplied by the trade size. Suppose you've bought 200 shares for $50 with a stop at $48.50, risking $1.50 per share. In that case, your open risk is $300. If that trade starts going your way and you move your stop to break-even, your open risk will become 0. 3. Add the two lines above losses for the month plus risks on open trades. If their sum comes to 6% of what your account equity was at the beginning of the month, you may not put on another trade until the end of the month or until the open trades move in your favor, allowing you to raise your stops. The 6% rule changes the usual question, do I have enough money for this trade? To a much more relevant one, do I have enough risk available for this trade? That limit, risking no more than 6% of your account equity in any given month, keeps your total risk under control, ensuring long-term survival. Your total available risk for the month is 6% of your account equity, and the first question to ask yourself when considering a new trade is, considering all my open and closed trades for this month, do I have enough available risk for this trade? You know how much money, if any, you've lost during the current month. It's easy to calculate how much money you have at risk in your open trades. If your previous losses for this month plus your risk on existing trades expose you to a total risk of 6% of your account equity, you may not put on another trade. If the 6% rule doesn't allow you to put on a new trade, continue to track the stocks you're interested in. If you see a trade you really want to take, but don't have available risk, consider closing out one of your open trades to free up some risk. If you are near the 6% limit, but see a very attractive trade you wouldn't want to miss, you have two options. You can take profits on one of your open trades to free up available risk. Alternatively, you may tighten some of your protective stops, reducing your open risk. Just be sure that in your eagerness to trade you do not make your stops too tight. See Chapter 54. Let's review an example, assuming, for the sake of simplicity, that a trader will risk 2% of his account equity on any given trade. 1. At the end of the month, a trader has $50,000 in his account with no open positions. He writes down his maximum risk levels for the month ahead, 2% or $1,000 per trade and 6% or $3,000 for the account as a whole. 2. Several days later, he sees a very attractive stock A, figures out where to put his stop, and buys a position that puts $1,000 or 2% of his equity at risk. 3. A few days later, he sees a stock B and puts on a similar trade, risking another $1,000. 4. By the end of the week, he sees a stock C and buys it, risking another $1,000. 5. The next week, he sees a stock D more attractive than any of the three above. May he buy it? No, he may not, because his account is already exposed to 6% risk. He has 3 open trades, risking 2% on each, which means he may lose 6% if the market turns against him. The 6% rule prohibits him from taking any more risks at this time. 6. A few days later, the stock A rallies and the trader moves his stop above break-even. Stock D, which he wasn't allowed to trade just a few days ago, still looks very attractive. May he buy it now? Yes, he may, because his current risk is only 4% of his account. He is risking 2% in stock B and another 2% in stock C, but nothing in stock A because its stop is above break-even. The trader buys stock D, risking another $1,000 or 2%. 7. Later in the week, the trader sees stock E, which looks very bullish. May he buy it? Not according to the 6% rule, because his account is already exposed to a combined risk of 6% in stocks B, C, and D. There is no longer a risk in stock A. He may not buy stock E. 8. A few days later, stock B hits its stop. Stock E still looks attractive. May he buy it? No, since he already lost 2% on stock B and has a 4% exposure to risk in stocks C and D. Adding another position at this time would expose him to more than 6% risk per month. 3 open trades isn't a lot of diversification. If you wish to make more trades, set your risk per trade at less than 2%. For example, if you risk only 1% of your account equity on any trade, you may open up to 6 positions before maxing out at the 6% limit. In trading a large account, I use the 6% rule, but tighten the 2% rule to well under 1%. The 6% rule allows you to increase your trading size when you're on a winning streak, but makes you stop trading early in a losing streak. When markets move in your favor, you can move your stops to break-even and have more available risk for new trades. On the other hand, if your positions start going against you and hitting stops, you'll quickly stop trading and save the bulk of your account for a fresh start next month. The 2% rule and the 6% rule provide guidelines for pyramiding, adding to winning positions. If you buy a stock and it climbs high enough to raise your stop above break-even, then you may buy more of the same stock, as long as the risk on the new position is no more than 2% of your account equity and your total account risk is less than 6%. Handle each addition as a separate trade. Many traders go through emotional swings, feeling elated at the highs and gloomy at the lows. Those mood swings will not help you trade, just the opposite. It is better to invest your energy in risk control. The 2% and the 6% rules will convert your good intentions into the reality of safer trading. 52. A comeback from a drawdown. When the level of risk goes up, our ability to perform goes down, Beginners make money on small trades, start feeling confident, and jack up trade size. That's when they start losing. The increased level of risk on bigger positions makes them stiffer and less nimble, and that's all it takes to fall behind. I saw a great example of that while running a psychological training group for a day trading firm in New York. That firm taught its traders a proprietary stock trading system and let them trade the firm's capital on a profit-sharing basis. Their two top traders were making up to $1 million a month. Others made much smaller profits, but quite a few lost money. The firm's owner asked me to come and help losing traders. They were shocked to hear that a psychiatrist was coming and loudly protested they weren't crazy. The owner provided the motivation by telling his worst performers they had to participate, or else leave the firm. After 6 weeks, the results were such that we had a waiting list for the second group. Since the company taught traders its own system, we focused on psychology and risk control. In one of our first meetings, a trader complained that he had lost money each day for the past 13 days. His manager, who sat in on our meetings, confirmed that the fellow was using the firm's system but couldn't make any money. I began by saying that I'd take off my hat for anyone who lost 13 days in a row and had the emotional strength to come in and trade the next morning. I asked the man how many shares he traded, since the firm set a maximum for each trader. He was permitted to buy or sell up to 700 shares at a clip, but voluntarily reduced it to 500. I told him to drop his size down to 100 shares until he had a week with more winning days than losing and was profitable overall. Once he cleared that hurdle for 2 weeks in a row, he could go up to trading 200 shares at a clip. Then, after another 2-week profitable period, he could go up to 300 shares and so on. He was allowed a 100-share increment after 2 weeks of profitable trading, but if he had a single losing week, he'd have to drop back to the previous level. In other words, he had to start small, increase the size slowly, but drop it fast in case of trouble. The trader loudly objected that 100 shares weren't enough to make money. I told him to stop kidding himself, since by trading 500 shares he wasn't making any money either, and he reluctantly agreed. When we met a week later, he reported that he had 4 profitable days and was profitable overall. He made very little money because of the 100-share size, but he was ahead of the game. He continued to make money during the next week and then stepped up to 200 shares. After another profitable week, he asked, "Doc, do you think this could be psychological?" The group roared. Why would a man lose while trading 500 shares but make money trading 100 or 200? I took a $10 bill out of my pocket and asked whether anyone in our group would like to earn it by climbing on top of our long and narrow conference table and walking from one end to the other. Several hands went up. "Wait," I said, "I have a better offer. I'll give $1,000 cash to anyone who comes with me up to the roof of our 10-story office building and uses a board as wide as this table to walk to the roof of another 10-story building across the boulevard." No volunteers. I started egging on the group. "The board will be sturdy. We'll do it on a windless day. I'll pay $1,000 cash on the spot." The physical challenge would be the same as walking on the conference table, but the reward so much greater. Still no takers. Why? Because if you lose your balance on the table, you'll jump down a couple of feet and land on the carpet. If you lose your balance between 2 rooftops, you'd be splattered on the asphalt. The higher levels of risk impair our ability to perform. You need to train yourself to accept risks slowly and in well-defined steps. Depending on how actively you trade, those steps can be measured in weeks or months, but the principle remains the same. You need to be profitable during 2 units of time to go up a step in your risk size. If you lose money during 1 unit of time, drop down a step in your risk size. This is especially useful for people who want to return to trading after a bad drawdown. You need to gradually work your way back into trading without an upsurge of fear. Most beginners are in a hurry to make a killing, but guess who gets killed? Unscrupulous brokers promote overtrading, putting on trades that are too big for your account to generate commissions. Some stockbrokers outside the United States offer a shoulder of 101, allowing you to buy $10,000 worth of stock for every $1,000 you deposit with the firm. Some Forex houses offer a deadly shoulder of 1,001 and even 4,001. Putting on a trade is like diving for treasure. There is gold on the ocean floor, but as you scoop it up, remember to glance at your air gauge. The ocean floor is littered with the remains of divers who saw great opportunities but ran out of air. A professional diver always thinks about his air supply. If he doesn't get any gold today, he'll go for it tomorrow. He needs to survive and dive again. Beginners kill themselves by running out of air. The lure of free gold is too strong. Free gold. It reminds me of a Russian saying, "The only free thing is this world is cheese in a mousetrap." Successful traders survive and prosper thanks to their discipline. The 2% rule will keep you safe from the sharks, while the 6% rule will save you from the piranhas. If you follow these rules and have a reasonable trading system, you'll be miles ahead of your competitors. A trading manager. Used to puzzle me why institutional traders as a group performed so much better than private traders. An average private trader in the United States is a 50-year-old, married, college-educated man, often a business owner or a professional. You would think this thoughtful, computer-literate book-reading individual would run circles around some loud 23-year-old who used to play ball in college and hasn't read a book since his junior year. In reality, institutional traders as a group outperform private traders year after year. Is it because of their fast reflexes? Not really, because young private traders perform no better than older ones. Nor do institutional traders win because of training, which is skimpy in most firms. Curious fact, when successful institutional traders go out on their own, most of them lose money. They may lease the same gear, trade the same system, and stay in touch with their contacts, but still fail. After a few months, most cowboys are back in headhunters' offices, looking for a trading job. How come they could make money for the firms but not for themselves? When an institutional trader quits his firm, he leaves behind his manager, the person in charge of discipline and risk control. That manager sets the maximum risk per trade. It is similar to what a private trader can do with the 2% rule. Firms operate from huge capital bases, and their risk limits are much higher in dollar terms but tiny in percentage terms. A trader who violates his risk limit is fired. A private trader can break the 2% rule and nobody will know, but an institutional manager watches his traders like a hawk. A private trader can throw confirmation slips in a shoebox, but a trading manager quickly gets rid of impulsive people. He enforces discipline that saves institutional traders from disastrous losses, which destroy many private accounts. In addition to setting a risk limit per trade, a manager sets the maximum allowed monthly drawdown for each trader. When an employee sinks to that level, his trading privileges are suspended for the rest of the month. A trading manager breaks his traders' losing streaks by forcing them to stop trading if they reach their monthly loss limit. Imagine being in a room with coworkers who actively trade, while you sharpen pencils and get asked to run out for sandwiches. Traders do all in their power to avoid being in that spot. This social pressure creates a serious incentive not to lose. People who leave institutions know how to trade, but their discipline is often external, not internal. They quickly lose money without their managers. Private traders have no managers. This is why you need to become your own manager. The 2% rule will save you from disastrous losses, while the 6% rule will save you from a series of losses. The 6% rule will force you to do something most people cannot do until it's too late: break a losing streak. Part 10. Practical details. Will you be buying stocks that break out to new highs, shorting double tops, buying pullbacks, looking for trend reversals? Those approaches differ from each other, and you can make or lose money with each of them. You need to select a method that makes sense to you and feels emotionally comfortable. Choose what appeals to you, what matches your abilities and temperament. There is no such thing as generic trading, any more than there is a generic sport. To find good trades, you need to define the pattern you want to trade. Prior to using any scan, you need to have a crystal clear picture of what it should look for. Develop your system and test it with a series of small trades to make sure you have the discipline to follow your signals. You have to feel certain that you'll trade the pattern you've identified when you see it. Different styles of trading call for different entry techniques, different methods of setting stops and profit targets, and very different scans. Still, there are several key principles that apply to all systems. 53. How to set profit targets. Enough is the power word. Setting profit targets for your trades is like asking about pay and benefits when applying for a job. You may end up earning more or less than expected, but you need to have an idea of what to expect. Write down your entry-level profit target and stop for every planned trade in order to compare your risk and reward. Your potential reward should be at least twice as big as your risk. It seldom pays to risk $1 to make $1. You might as well bet on color at a roulette table. Having a realistic profit target and a firm stop will help you make a go-no-go decision for any trade. Early in my trading career, I didn't think of profit targets. If anybody asked me about them, I'd answer that I didn't want to limit my profit potential. Today, I would laugh at such an answer. A beginner without a clear target price will feel increasingly happy as his stock goes up and more despondent as it grinds down. His emotions will prime him to act at the worst possible times, continue to hold and add to his longs at the top, and sell out in disgust near the bottom. In calculating a trade's profit potential, we run into a paradox. The longer your expected holding period, the bigger the profit potential. A stock can rally much more in a month than in a week. On the other hand, the longer your holding period, the higher the level of uncertainty. Technical analysis can be quite reliable for shorter-term moves, but many unpleasant surprises will occur in the longer run. In an earlier chapter on choosing the time horizon for trades, we examined our three main options. The holding period for position trades or investments is measured in months, sometimes years. We may hold a swing trade for a few days, sometimes weeks. The expected duration of a day trade is measured in minutes, rarely hours. Moving averages and channels help set profit targets for swing trades. Also work for day trades. Only there you need to pay more attention to oscillators and exit at the first sign of a divergence against your trade. Profit targets in position trading are usually set at previous support and resistance levels. The three targets mentioned above, moving averages, channels, and support resistance levels, are fairly modest. They don't have you shooting for the moon, but are realistic. Keep in mind that enough is a power word in life as well as trading. It puts you in control, and by getting enough in one trade after another, you'll achieve excellent results over time. How to define enough? I believe that moving averages and envelopes, along with recent support and resistance levels, can show us what would be enough for any given trade. Let me illustrate this with several examples. One a swing trade, another a day trade, and the third a long-term investment. The RSN was a fairly common example of a modest swing trade. Entering near one of the channel lines and taking profits in the value zone between the two moving averages, figure 53.1. This isn't elephant hunting. This is rabbit hunting, a much more reliable activity. The EGO day trade in figure 53.2 illustrates buying a pullback into the value zone during an uptrend, with a profit target at the upper channel line. I used an oscillator to speed up my exit when the market wouldn't let me exit at the initial target. Fallen Angels is the name of a scan I use to look for possible investment candidates. It marks stocks that have fallen over 90% from their peaks, stopped declining, bottomed out, and slowly began to rise. A stock that had lost 90% of its value has every right to die, but if it chooses to live, it's likely to rally. The best time to look for fallen angels is when a bear market starts showing signs of bottoming. That's when you find many candidates that survived bear attacks and are starting to get up from the floor. This example shows an old bull market darling IGOI that got badly mauled but stopped declining and began to rise. The weekly chart in figure 53.3 shows two prior attempts to return to the multi-year peak area. Each of those rallies retraced just about half of the previous bear market. Is this going to be an easy trade? Far from it. First of all, the latest bottom was near $2, and if you place your stop there, your risk per share will be quite high and you'll have to reduce trade size. Also, the expected rally may take anywhere from a few months to several years to get going. Are you prepared to wait that long with your capital tied up? Last but not least, the volume of this stock is low. It will rise if prices rally, but if the rally fizzles out, selling will not be easy. Taking all these factors into account, you can see how hard it is to buy for the long haul. 54. How to set stops. Say no to wishful thinking. A trade without a stop is a gamble. If you're after thrills, better go to a real casino. Take a trip to Macau, Las Vegas, or Atlantic City, where a gambling house will serve you free drinks and may even comp you a room while you're having fun. Gamblers who lose money on Wall Street receive no freebies. Stops are a must for long-term survival and success, but most of us feel a great emotional reluctance to use them. The market reinforces our bad habits by training us not to use stops. We all have been through this unpleasant experience. You buy a stock and set a stop that gets hit, and you exit with a loss, only to see your stock reverse and rally just as you originally expected. Had you held that stock without a stop, you would have profited instead of losing. Getting repeatedly whipsawed like that makes you feel disgusted with stops. After several such events, you start trading without stops, and it works beautifully for a while. There are no more whipsaws. When a trade doesn't work well, you get out of it without a stop. You have enough discipline. This happy ride ends after a large trade starts going bad. You keep waiting for it to rally a bit and give you a better exit, but it keeps sinking. As the days go by, it inflicts more and more damage on your account. You're being chewed up by a shark. Soon enough, your survival is in danger and your confidence is shattered. While you trade without stops, the sharks circling the perimeter of every account grow bigger and meaner. If you trade without stops, a shark bite is only a question of time. Yes, stops are a pain, but using them is a lesser evil than trading without them. This reminds me of what Winston Churchill said about democracy. It is the worst form of government except all the others that have been tried. What should we do? I suggest accepting the irritation and the pain of stops, but focusing on making them more logical and less unpleasant. In my previous book, The New Sell and Sell Short, I dedicated a long chapter to the intricacies of placing various types of stops. Rather than repeat myself here, I'll offer you a quick summary. Place stops outside the zone of market noise. Put a stop too close, and it'll get whacked by some meaningless intraday swing. Put it too far, and you'll have very skimpy protection. To borrow an engineering concept, all market moves have two components: signal and noise. The signal is the trend of your stock. When the trend is up, we can define noise as that part of each day's range that protrudes below the previous day's low. When the trend is down, we can define noise as that part of each day's range that protrudes above the previous day's high. Safe zone stops are described in detail in Come Into My Trading Room. They measure market noise and place stops at a multiple of noise level away from the market. In brief, use the slope of a 22-day EMA to define the trend. If the trend is up, mark all downside penetrations of the EMA during the look-back period 10 to 20 days, add their depths, and divide the sum by the number of penetrations. This gives you the average downside penetration for the selected look-back period. It reflects the average level of noise in the current uptrend. You want to place your stops farther away from the market than the average level of noise. That's why you need to multiply an average downside penetration by a factor of 2 or greater. Placing your stop any closer would be self-defeating. When the trend, as defined by the EMA slope, is down, we calculate safe zone on the basis of upside penetrations of the previous bar's highs. We count each upside penetrations during a selected time window and average that data to find the average upside penetration. We multiply it by a coefficient, starting with 3, and add that to the high of each bar. Shorting near the highs requires wider stops than buying near quiet, sold-out bottoms. Like all systems and indicators in this book, Safe Zone is not a mechanical gadget to replace independent thought. You have to establish the look-back period, the window of time during which Safe Zone is calculated. You also need to fine-tune the coefficient by which you multiply the average penetration so that your stop goes outside the normal noise level. Even when not using Safe Zone, you may wish to follow its principle of calculating an average penetration against the trend that you are aiming to trade, and putting your stop well outside the zone of market noise. Don't place your stops at obvious levels. A recent low that sticks out like a sore thumb from a tight weave of prices draws traders to place stops slightly below that level. Trouble is most people place their stops there, creating a target-rich environment for the running of stops. The market has an uncanny habit of quickly sinking back to those obvious lows and triggering stops before reversing and launching a new rally. Without trying to assign blame for raiding stops, let me suggest several solutions. It pays to place your stops at non-obvious levels, either closer to the market or deeper below an obvious low. Closer stop will cut your dollar risk but increase the risk of a whipsaw. A deeper stop will help you sidestep some false breakouts, but if it gets hit, you'll lose more. Take your pick. For short-term swing trading, it generally pays to place your stops tighter, while for long-term position trades, you'd be better off with wider stops. Remember the iron triangle of risk control. A wider stop demands a smaller trade size. One method I like is Nick's stop, named after my Australian friend Nick Grove. He invented this method of placing a stop not near the lowest low, but at the second lowest, more shallow low. The logic is simple. If the market is sliding to its second lowest low, it is almost certain to continue falling and hit the key low, where the bulk of stops cluster. Using Nick's stop, I get out with a smaller loss and lower slippage than would occur when the markets drop to more visible lows. The same logic works when shorting. Place your Nick stop not a tick above the highest high, but at the level of the second highest high. Let's review some recent examples of both longs and shorts in Figure 54.1. You may want to explore several different systems for placing stops, such as parabolic, safe zone, and volatility stops, described in the books mentioned above. You can get fancy or you can stay plain, but keep in mind the most important principles. First, use stops, and second, don't place them at obvious levels, easily visible to anyone looking at that chart. Make your stops a little tighter or wider than average. Stay away from the crowd because you don't want to be an average trader. For the same reason, avoid placing stops at round numbers. If you buy at $80, don't place a stop at $78, but at $77.94. If you enter a day trade at $25.60, don't place a stop at $25.25. Move it to $25.22 or even $22.19. Round numbers attract crowds. Put your stop a little farther away. Let the crowd take the first hit, and perhaps your own stop will remain untouched. Another method, popularized by Carrie Lovevorn, is to use average true range adder stops. See Chapter 24 for the explanation of the ATR. When you enter during a price bar, place your stop at least one ATR away from the extreme of that bar. A 2 ATR stop is even safer. You can use it as a trailing stop, moving it at every bar. The principle is the same. Place your stop outside the zone of market noise. Figure 54.2. One of the advantages of using trailing stops is that they gradually reduce the amount of money at risk. Earlier, we discussed the concept of available risk, Chapter 51. As a trade followed by a trailing stop moves in your favor, it gradually frees up available risk, allowing you to make new trades. Even if you don't use safe zone or ATR stops, be sure to place stops at some distance from recent prices. You don't want to be like one of those fearful traders who jam their stops so close to current prices that the slightest meaningless fluctuation is certain to hit them. The concept of signal and noise can help you not only place intelligent stops, but also find good entries into trades. If you see a stock in a strong trend but don't like to chase prices, drop down one time frame. For example, if the weekly trend is up, switch to the daily chart, and you'll probably see that once every few weeks, it has a pullback below the value zone. Measure the depths of several recent penetrations below the slow EMA to calculate an average penetration. See Figure 39.3. Place a buy order for the day ahead at that distance below the EMA and keep adjusting it every day. You will use a splash of noisy behavior to get a good entry into a trend-following trade. Don't let a winning trade turn into a loss. Never let an open trade that shows a decent paper profit turn into a loss. Before you put on a trade, start planning at what level you'll begin protecting your profits. For example, if your profit target for that trade is about $1,000, you may decide that a profit of $300 will need to be protected. Once your open profit rises to $300, you'll move your protective stop to a break-even level. I call that move cuffing the trade. Soon after moving your stop to break-even, you'll need to focus on protecting a portion of your growing paper profit. Decide in advance what percentage you'll protect. For example, you may decide that once the break-even stop is in place, you'll protect a third of your open profit. If the open profit on the trade described above rises to $600, you'll move up your stop so that the $200 profit is protected. These levels aren't set in stone. You may choose different percentages, depending on your level of confidence in a trade and risk tolerance. As a trade moves in your favor, your remaining potential gain begins to shrink, while your risk, the distance to the stop, keeps increasing. To trade is to manage risk. As the reward-to-risk ratio for your winning trades slowly deteriorates, you need to begin reducing your risk. Protecting a portion of your paper profits will keep your reward-to-risk ratio on a more even keel. Move your stop only in the direction of your trade. You buy a stock and, being a disciplined trader, put a stop underneath. That stock rises, generating nice paper profits, but then it stalls. Next, it sinks a little, then a bit more, and then goes negative, inching towards your stop. As you study the chart, its bottom formation looks good, with a bullish divergence capable of supporting a strong rally. What will you do next? First of all, learn from your mistake of not having moved up your stop. That stop should have been raised to break-even a while ago. Failing that, your options have narrowed. Take a small loss right away and be ready to reposition later, or continue to hold. Trouble is you feel tempted to go for the third and utterly unplanned choice to lower your stop, giving your losing trade more room. Don't do it. Giving a trade more room is wishful thinking, pure and simple. It doesn't belong in the toolkit of a serious trader. Giving more room to a losing trade is like telling your kid you'll take away his car keys if he misbehaves, but then not following through. That's how you teach him that rules don't matter and encourage even worse behavior. Standing firm brings better long-term results. The logical thing to do when a trade starts acting badly is to accept a small loss. Continue to monitor that stock and be ready to buy it again if it bottoms out. Persistence pays, commissions are cheap, and professional traders often take several quick stabs at a trade before it starts running in their favor. Catastrophic stops. A professional's life jacket. Soon after moving to a house near a lake, I bought a kayak and immediately went shopping for a life jacket. All I had to do to be legal was to have a jacket in the kayak. Any cheap piece of junk would suffice. Still, I spent good money on a quality jacket that felt snug and didn't interfere with rowing when I wore it. All I planned to do with that kayak was to paddle peacefully on a lake, not anywhere near white water or currents. I never expected to actually need that jacket. Did I waste my money buying it? Well, if ever some motorboat clips me, then wearing a high-quality jacket can make the difference between life and death. It's the same with stops. They're a nuisance and often cost you money. Still, there will be a day when a stop will save your account from a life-threatening collision. Keep in mind that a bad accident is much more likely in the market than on a lake. That's why it's essential to use stops. A hard stop is an order you give to your broker. A soft stop is an order you keep in your head, ready to place it when needed. Beginners and intermediate traders must use hard stops. A professional trader, sitting in front of a live screen all day, may use a soft stop if he has the discipline to exit when his system tells him to do it. Still, accidents happen. A professional trader friend described how he fought against a market reversal. His soft stop was set at a $2,000 loss level, but by the time he threw in the towel and got out, his loss grew to $40,000, the worst of his trading career. This is why, even if you don't use hard stops on a regular basis, you should at the very least use a catastrophic stop for every trade. For any trade, whether long or short, draw a line on your chart where you absolutely do not expect that stock to go. Place your hard stop at that level and make it GTC. Good till canceled. That will be your catastrophic stop. Now you can play with the luxury of soft stops. Paddle your kayak hard, knowing that you're wearing a reliable life jacket. Had my friend whose $2,000 drawdown metastasized into a $40,000 loss used a hard, catastrophic stop, he would have taken only a relatively small loss, sidestepped a disaster, and avoided the financial and psychological hurt of a shark bite. Stops and overnight gaps. Only for the pros. What will you do if your stock gets hit by a major piece of bad news after the market closes for the day? Looking at pre-opening quotes the next morning, you realize that it'll open sharply lower, deep below your stop, promising massive slippage. This is a rare occurrence, but it does happen. If you're a new or intermediate trader, there isn't much you can do, just grit your teeth and take your loss. Only coldly disciplined pros have an additional option: day trade your way out of that stock. Pull your stop, and after the stock begins trading, handle it as if it was a day trade you bought at the first tick of that morning. Opening gaps are often followed by bounces, giving nimble traders an opportunity to get out at a smaller loss. This doesn't always happen, which is why most traders should never use this technique. You may actually deepen your loss instead of reducing it. Be sure to get out before the close. Your damaged stock may bounce today, but tomorrow more sellers are likely to come in and drive it lower. Don't let a bounce lull you into a false hope of a reversal. 55. Is this a trade? Your performance in any field will improve if you take tests. Getting graded on them will help you recognize your strengths and weaknesses. Now you can work on reinforcing what's good and correcting what's not. Whenever you complete a trade, the market gives you 3 grades. It grades the quality of your entry and exit, and most importantly, it delivers your overall trade grade. If you're a swing trader and use a combination of weekly and daily charts, look for your grades on the dailies. Your buy grade is based on the location of your entry, relative to the high and low of the daily bar during which you bought. The closer to the bar's low and the farther away from the bar's high you buy, the better your buy grade. Suppose the high of the day was $20, the low $19, and you managed to buy at $19.25. Entering those numbers into the formula gives you a buy grade of 75%. If your buy grade is 100%, it means you bought at the bottom tick of the day. That's brilliant, but don't count on it happening. If your buy grade is 0%, it means you bought the top tick of the day. This is terrible and should serve as a reminder not to chase runaway prices. I calculate my buy grade for every trade and consider anything above 50% a very good result, meaning I bought in the lower half of the daily bar. The following is the formula for your sell grade. The closer to the bar's high and the farther away from the low of the bar you sell, the better your sell grade. Suppose the high of the day was $20, the low $19, and you managed to sell at $19.70. Entering those numbers into the formula gives you a sell grade of 70%. If your sell grade is 100%, it means you sold at the top tick of the day. If your sell grade is 0%, it means you sold at the bottom tick of the day. This terrible grade should serve as a reminder to sell earlier instead of panicking. I calculate my sell grade for every trade and consider anything above 50% a very good result, meaning I sold in the upper half of the daily bar. When evaluating any trade, most people assume that the amount of money they make or lose in that trade reflects its quality. Money is important for plotting the equity curve, but it's a poor measure of a single trade. It makes more sense to rate the quality of every trade by comparing what you've got to what was realistically available. I find my trade grade by comparing points gained or lost in a trade to the height of the daily charts channel measured on the day of the entry. A well-drawn channel contains between 90% and 95% of prices for the past 100 bars. See Chapter 22. You may use any number of channels parallel to the EMA, auto-envelope, Keltner, or ATR channels as long as you're being consistent. Channel contains normal price moves, with only the extreme highs and lows protruding outside it. The distance between the upper and the lower channel lines on the day you enter a trade represents a realistic maximum of what's available to a swing trader in that market. Shooting for a maximum, though, is a very dangerous game. I consider any trade that gains 30% or more of its channel height in a trade. Figure 55.1. Comment by Kerry Lovevorn at the 2012 annual reunion of Spike Trade grabbed my attention. He challenged all participants to define what he called a trade, a setup that signals the likelihood of an excellent trade. You have to define this pattern for yourself, he said. If you don't know what's your trade, you have no business being in the market. I knew full well what my trades were: a divergence coupled with a false breakout or a pullback to value. Still, if I saw no trades on my screen, I'd go for B trades and on a really slow day reach for a C trade. Returning home from that reunion, I attached a plastic strip to one of my trading screens with the question, "Is this a trade?" Ever since then, I have it in front of me whenever I place an order. The results came quickly. As the number of non-trades sharply declined, my equity curve began to rise at a steeper angle. You need to have a clear idea of what would be a perfect setup for you, and a trade. Perfect doesn't guarantee profits. There are no guarantees in the market, but it means a setup with a strong positive expectation. It also means something you've traded before with which you are comfortable. Once you know what it is, you can start looking for stocks that exhibit that pattern. One of the few advantages of a private trader over an institutional one is that we can trade or not trade when we like. We have the luxury of being free to wait for excellent setups. Unfortunately, most of us, in our eagerness to trade, throw away this amazing advantage. I've added the question, is this a trade? To my trade bill, a trade management form we'll discuss in the next chapter. Whenever I see a potential trade, I ask myself this question. If the answer is yes, I start calculating risk management, position sizing, and planning my entry. If the answer is no, I turn the page and go looking for another pick. Figure 55.2. No matter how grand an idea or a stock tip, I will not trade it unless it fits into one of my three strategies. Ideas come and go, fly or flop, but strategies stay and grow better with age as you learn how they perform under various market conditions. Gradually, you may develop new strategies and drop others. You can see that the ones I use are numbered 1, 4, and 7. The rest of the numbers were strategies I stopped using. Your system can be very mechanical or quite general, with just a few key principles, like my triple screen. Either way, you must know what your trade looks like before you plan your next trade. I'll walk you through one of my strategies, but remember that you don't have to copy it. Figure 55.3. The way we trade is as personal as handwriting. Define a strategy that feels comfortable to you, test it, and then find a chart that perfectly represents it. Print that chart and post it on a wall near your trading desk. Now you can search for trades that look the way that chart looked on the day you entered that trade. In the next section, on trade planning, you'll see how to use a form I named Trade Bill to make trading decisions more objective. Every trade has several parameters, and it's easy to overlook some of them in the heat of action. Just as a pilot goes through a pre-flight checklist, a trader needs to check his list before deciding to place an order. 56. Scanning for possible trades. There are thousands of stocks out there, and in the days and weeks ahead, some will rise, others fall, and some will fluctuate. Each stock will make money for traders whose systems are in gear with it, and lose money for the rest. Developing a trading system or a strategy must come before scanning. If you don't have a clearly defined strategy, what will you scan for? Begin by developing a system that you trust. Once you have it, looking for trading candidates will become quite logical and straightforward. Looking at your list of candidates, the first question about any pick will be, is this a trade? In other words, is this pick close to your ideal pattern? If the answer is yes, you may start working up a trade. Scanning means reviewing a group of trading vehicles and zooming in on trading candidates. Your scanning can be visual or computerized. You may flip through multiple charts, taking a quick glance at each, or else have your computer run through that list and flag stocks whose patterns appeal to you. To repeat, defining a pattern you trust must be your first step, scanning a more distant second. Be sure to have realistic expectations for scanning. No scan can find you the needle in a haystack, the one and only gem to trade. What a good scan does is bring up a group of candidates on which to focus your attention. You can make that group bigger or smaller by loosening or tightening scan parameters. Scan is a time saver that delivers potential candidates. It is not a piece of magic to free you from the necessity of working up your picks. Begin by describing what stocks you want to find. For example, if you're a trend follower, but don't like chasing stocks, you may design a scan to find stocks whose moving average is rising but the latest price is only a small percentage above that average. You can write a scan yourself or hire someone to do it for you. There are programmers who offer this service. The raw list of stocks to be scanned can be as small as a few dozen or as large as the S&P 500 or even Russell 2000. I like looking for trading candidates on weekends, and depending on how much time I have, take one of the two approaches, one lazy and the other hardworking. The lazy way, when my time is limited, is to review Spiker's picks for the week ahead. Spikers are the elite members of Spike TradeCom, and I figure that among a dozen picks by super smart traders who compete for the best pick of the week, there ought to be a stock or two for me to piggyback. I examine those picks while adding my market opinion to the mix. Depending on my outlook for the week ahead, I focus primarily on long or short candidates. The hard-working way consists of dropping all 500 components of the S&P 500 into my software and running a scan for potential MACD divergences. I've seen many divergence scans, but never a reliable one. They all delivered too many false positives and missed many good divergences. And I realized that a divergence was an analog pattern, clearly visible to a naked eye but hard to pick with digital processing. I turned to John Bruns, who built me a semi-automatic MACD divergence scanner. Instead of looking for divergences, it scans for patterns that precede divergences and delivers the list of candidates to watch in the days ahead. Figure 56.1. Running my MACD divergence semi-automatic scan over the weekly and daily charts of all 500 components of the S&P 500 takes only a minute, but the real work begins when I review the lists of bullish and bearish candidates delivered by this scan. First, I compare the sizes of bullish and bearish lists. For example, for several weeks prior to writing this chapter, my scan for bullish divergences among the components of the S&P 500 produced 4 to 5 candidates, while the scan for potential bearish divergences returned between 70 and 80 stocks. This great imbalance indicated that the market was perched at the edge of a cliff, and I needed to find some shorts for the coming downturn. I pruned my weekly list of trading candidates down to 5 or 6 picks that show the most attractive patterns and the best reward-to-risk ratios. These are the stocks that I'll aim to trade during the week. I have friends who can juggle 20 stocks at once. This can be done, but not by me, and every serious trader must know his limitations. Another hard-working way of finding trade candidates involves scanning stock industry groups. For example, if I think that gold is approaching an important bottom, I'll pull up the list of all 52 gold stocks and 14 silver stocks that are listed at this time and look for buying candidates. While doing that, I'll keep in mind my SLB chart shown in figure 55.3. I want to find stocks whose patterns look close to my ideal. If you're going to scan a large number of stocks, it pays to add some negative rules. For example, you may want to omit stocks whose average daily volume is below 500,000 or even 1,000,000 shares. Their charts tend to be more ragged and their slippage worse than in more actively traded stocks. You may want to exclude expensive stocks from your scans for buying candidates and cheap stocks from your scans for shorting candidates. Choosing at what levels to place your price filters is a matter of personal choice. This is why scanning is best left for experienced traders. Learn to fish with just a few lines in the water before casting a broad net. Part 11. Good record keeping. There is no free lunch. As with so many other things, either you're going to pay up front or you're going to pay on the back end for being disorganized, and unfortunately, when you pay on the way out, it's always more expensive. Writes Andrew J. Mellon in Unstuff Your Life. The market is perversely inconsistent in dishing out rewards and punishments. There is always a chance that a poorly planned trade may bring profits, while a well-planned and carefully executed trade may end in a loss. This random reinforcement subverts our discipline and encourages sloppy trading. Good record keeping is the best tool for developing and maintaining discipline. It ties together psychology, market analysis, and risk management. Whenever I teach a class, I say, show me a trader with good records and I'll show you a good trader. Writing down your trade plans will ensure that you don't miss any essential market factors. Good record keeping will save you from stumbling into impulsive trades. Trading discipline is similar to weight control, which is very hard for most people. If you don't know what you weigh today and whether the curve of your weight is rising or falling, how can you control it? Losing weight begins with standing naked on a scale in the morning and writing down your weight for that day. We all make mistakes, but if you keep reviewing your records and reflecting on past mistakes, you'll be unlikely to repeat them. Good record keeping will turn you into your own teacher and do wonders for your account equity. A quick read of a chapter will not make you a disciplined trader. You'll have to invest hours in doing homework and accept the pain of having your stops hit. The work comes first, the rewards later. As your account grows, you'll experience a wonderful feeling of accomplishment. Let's review the 3 key components of record keeping. 1. Discipline begins with doing your homework. I'll offer you a homework spreadsheet. 2. Discipline is reinforced by writing down your trade plans. I'll offer you PDF files for working up long and short candidates. 3. Discipline culminates in executing those plans and completing trade records. I'll offer you a link to an online trade journal. Please feel free to personalize all of these documents. The markets are huge and diverse, and there is no one-size-fits-all system of analysis, trading, and record keeping. The basic principles are in this book, but the way you implement them can be your own. 57. Your daily homework. When you wake up in the morning and know that you need to be at the office in an hour, you don't spend time planning every little step. You follow an established routine, get out of bed, wash, get dressed, have breakfast, get in a car, etc. This routine puts you in the groove for the day ahead, leaving your mind free for strategic thinking. By the time you arrive at the office, you're ready to face the day. It pays to have a morning routine for the market, a sequence of steps for touching base with the key factors that may dominate today's trading. This routine should put you in gear with the market before the opening bell, making you alert and ready to act. I use a spreadsheet for my pre-open routine. The person who gave me this idea was Max Larson, a money manager in Ohio. I've changed Max's spreadsheet. My current version is numbered 3.7, reflecting 2 major revisions and a handful of lesser ones. It is based on how I view the markets, while its embedded links help me reach various websites for the information I want. My homework spreadsheet, figure 57.1, is a work in progress, as I keep adding and deleting lines. If you start using it, I'm sure that you'll modify it to suit your preferences. My firm, Eldercom, offers my latest spreadsheet, complete with its psychological self-test as a public service. Simply write to info@Eldercom and ask for it. After filling out this spreadsheet, I turn to my open trades. I review their stops and profit targets, making any adjustments for the coming day if necessary. Then, if I'm planning to trade today, I review my short list of candidates, focusing on planned entries, targets, and stops. Now I am in gear with the market, ready to place orders. I do this homework even if I know that I will not be able to trade during the day, for example when traveling. This discipline is just like washing and dressing in the morning, even on the days when you don't plan to go to the office. Are you ready to trade today? There are times when you feel in gear with the market, but at other times you're out of touch. Your mood, health, and time pressures influence your ability to trade. For example, imagine trading while suffering from a toothache. You can't fully concentrate on the market and should be calling your dentist, not your broker. This is why each morning I take a 30-second psychological self-test for an objective rating of my readiness to trade. The first person I saw use a self-test was Bob Blixinski, a former spiker. He may have posted his test online because in 2011, I saw Spike Trade member Erin Bruce present her self-test at that year's reunion. The questions she asked herself were completely different, but the format looked like Bob's. I modified Erin's self-test to fit my personality and take it every day before the market opens. Any self-test must be short and specific. Mine has only 5 questions, and each of them can have only one of 3 answers, yes, no, or so-so. We'll discuss the logic of designing such tests in the following chapter. If you start using this test, you'll probably modify it to fit your personality and ask the questions that are most important to you. Figure 57.2. A 0 rating on some of the questions also warns me not to trade. If I haven't done my trade planning or if my schedule is very booked up, this would be a bad day to trade. Better stand aside or place only exit orders. You, your mind, your mood, and your personality are the essential components of trading. This is why a quick self-test helps you see whether you should be trading today. 58. Creating and scoring trade plans. A plan for any trade must specify what strategy you'll use. Must prompt you to check the dates of earnings and dividends or contract rollovers in order to save you from being blindsided by predictable news. It must spell out your planned entry, target, and stop as well as your trade size. Writing down a trade plan makes it real. Once you enter a trade and your equity starts fluctuating, you may feel stressed and forget to perform certain tasks. The plan you write prior to entering a trade becomes your island of sanity and stability in the middle of a storm. It helps ensure that you don't overlook anything essential. A really good plan will include a scale for measuring its quality. This objective rating, which we'll discuss below, takes less than a minute, but it encourages you to implement only those plans that have a higher likelihood of success. Prompts you to drop marginal plans and not chase borderline trade ideas. While all my records are in electronic format, I like having my trade plans on paper. I use pre-printed forms that I name trade bills, similar to waybills that come with the packages we order online. When a company sends you a product, it comes with a waybill that shows the name of the product, its quantity, your address, the mode of delivery, rules for returns, and other essential facts. My trades are accompanied by trade bills from the planning stage to the closing day. I have 2 separate trade bills for each trading system, one for buying and another for shorting. Here we'll review a trade bill for one of my favorite strategies. You can use it as a starting point for developing your own trade bill. Whenever a potential trade catches my eye, I decide which system it fits and then pick up the appropriate blank trade bill. Right there, if a seemingly attractive trade fits no trading system, then there is no trade. Having decided on a system, I write down the date and the ticker symbol and then score that potential trade, as shown below. If the score is high enough, I proceed to complete my trade plan. Otherwise, I toss that sheet of paper into a wastebasket and go looking for other trades. Wherever I go, I carry my trade bills for open trades. If I'm at my desk, they are next to my keyboard. If I go out during the day and bring my laptop, I put those trade bills between the keyboard and the screen, so they'll be the first thing to see when I open up my laptop. Having written down my trade plans for years, I gradually developed a method for scoring them before making a go-no-go decision. My habit of scoring plans was reinforced when I read Thinking, Fast and Slow by Prof. Daniel Kahneman. This book on decision-making by a behavioral economist and a Nobel Prize winner underscored the value of simple scoring systems. They make our decisions more rational and less impulsive. Scoring your trade plans, a trade UPGAR. Among the examples in Prof. Kahneman's book was his description of the work of Dr. Virginia UPGAR, 1909-1974, a pediatric anesthesiologist at Columbia University. She is widely credited with saving countless lives. Doctors and nurses worldwide use the UPGAR scale for deciding which newborns require immediate medical care. Most babies are born normal, some have complications, while others are at risk of dying. Prior to Dr. UPGAR, doctors and nurses used clinical judgment to tell those groups apart, and their mistakes contributed to infant mortality. Dr. UPGAR's scoring system made their decisions objective. The UPGAR score summarizes answers to 5 simple questions. Each newborn is rated on its pulse, breathing, muscle tone, response to a pinch, and skin color. Good response to any question earns 2 points, poor 0, or 1 for an in-between. The test is generally done at 1 and 5 minutes after birth. Total scores of 7 and above are considered normal, 4 to 6 fairly low, and less than 4 critically low. Babies with a good score are safe to put into general care, while those with low UPGAR scores require immediate medical attention. The entire decision-making process, focusing on whom to treat aggressively, is quick and objective. Dr. UPGAR's simple scoring system has improved infant survival rates around the world. After reading Prof. Kahneman's book, I renamed my scoring system the Trade UPGAR. It helps me decide which of my trade ideas are strong and healthy or sickly and weak. Of course, as a trader, my actions are completely opposite to those of a pediatrician. A doctor focuses on the sickest kids to help them survive. As a trader, I focus on the healthiest ideas and trash the rest. Before I show you my Trade UPGAR, a word of caution. The scoring method you're about to see is designed for one system, my false breakout with a divergence strategy. All other systems will require a different test. Use my Trade UPGAR as a starting point for developing a test for your own system. For example, I recently gave the file of my Trade UPGAR to a professional option writer who consulted with me. He loved the idea of a written test, which reduced impulsivity, one of his key problems. Within a few weeks, he showed me his own Trade UPGAR, which greatly differed from mine. He replaced one of my indicators with his favorite RSI and stochastic, and added questions directly relevant only to option writing. I was happy to see that he was trading more profitably. A Trade UPGAR demands clear answers to 5 questions that go the heart of a trading strategy. As you develop a Trade UPGAR for your own strategy, I suggest keeping the number of questions down to 5 and rating your answers on a 0, 1, 2-point scale. Simplicity makes this test more objective, practical, and quick. While looking at a potential trade, I take a blank trade bill from a stack and circle my answers to its 5 questions. A circle in the red column earns a 0, in the yellow column 1 point, and in the green column 2 points. I write down each number in the score box and add up the 5 lines. Also, if I circle the red column, I may write in the box next to it at what price the answer will change to a more favorable yellow or green. That will raise the plan's score, allowing me to enter a trade at that level. Figure 58.1 shows a Trade UPGAR for going long. Figure 58.2 shows a Trade UPGAR for shorting. It takes less than a minute to generate a Trade UPGAR for any stock. I want to trade only healthy ideas whose score is 7 or higher, and not a single line rated 0. If the score is 7 or higher, I go on to complete my trade plan. I establish my entry, target, and stop, decide what size to trade, etc. Trade UPGARs provide objective ratings for potential trades. With thousands of trading vehicles available to us, there is no need to waste energy on poor candidates. Use a Trade UPGAR to help you zoom in on the best prospects, using a trade bill. Once you become interested in a stock and a Trade UPGAR confirms your idea for a trade, completing a trade bill will help you focus on the key aspects of that trade. Let's review a trade bill for long positions, figure 58.3. I designed my trade bills in PowerPoint, fitting 2 to a page. I always keep some blanks handy, but don't preprint too many because I keep tweaking these forms. My trade bull for short trades is the same, except for a different trade gar as shown in figure 58.2. When you start developing your own trade bulls, you may want to copy sections 1, 3, and 4, but develop your own section 2, the trade gar for your own system or strategy. 59. Trade Journal. Memory is the cornerstone of civilized life. It allows us to learn from our successes and even more from our failures. Keeping a diary of your trades will help you grow and become a better trader. Keeping detailed trade records feels burdensome, but that's what serious traders do. Many people asked me after I published a book of interviews with traders, entries and exits 2006, what all of them had in common. They lived in different countries, traded different markets, and used different methods, but all kept excellent records. The best example came from the woman whose interview was in the first chapter of that book. While finishing the manuscript, I realized that our interview had been incomplete and I needed to ask additional questions about her trades. A year later, on another visit to California where she lived, I asked to meet again. I assumed she'd show me some recent trades, but she went to a filing cabinet and pulled out a folder with all her trades for the week of my previous visit. We completed our interview by reviewing her charts from a year ago as if those trades were made yesterday. A bull market was in full swing. She was doing great, but still worked to improve her performance. Her detailed diary was her self-improvement tool. Let your diary entries serve as your extracranial memory, a tool for building the structure of success. For years, I struggled with developing a record-keeping system that would be easy to update and analyze. In the beginning, I kept the diary of my trades in a paper journal, gluing in chart printouts and marking them up. I still keep one of those antiques next to my trading desk. Later, I kept my diary in Word, and then in Outlook. Finally, in 2012, Carrie Lovevorn and I created a web-based trade journal. This trade journal is a joy to keep, and both Carrie and I use it for all our trade diaries. Our trade journal is available to all, and its use is free up to a limit. The journals are online, password protected, and absolutely private, although Spike Trade members have an option of sharing their trade journals for selected trades. Our trade journal is shown in figure 59.1. Even if you prefer to build your own, look at it to see what must be included in your own record-keeping system. The trade journal is designed to make your record-keeping simple and logical, helping you plan, document, and learn from your trades. We have already reviewed several sections of the trade journal. Figure 38.1 showed its 3 sections: setup, risk, and parameters. Figure 55.2 showed the strategy box in the trade journal. Most of us quickly forget past trades, but the trade journal prompts you to return to them. The trades you entered and exited at the hard right edge of the chart are now in the middle of that chart, where you can re-examine your decisions and learn how to improve them. 3 benefits. Keeping a trade journal delivers 3 major benefits. One is immediate, a greater sense of order. The second comes a month or 2 later, when you start reviewing your closed trades. Finally, after you accumulate dozens of records, you'll have several ways to analyze them and learn from your equity curves. A sense of order and structure comes from documenting the plan, the entry, and the exit for each trade. Where exactly will you enter? What is your target? Where will you place your stop? Defining and writing down those numbers will steer you towards disciplined trading. You'll become less likely to slip into an impulsive buy, overstay a profitable trade, or let a loss snowball without a stop. Filling out risk management numbers will give you a handle on trade sizing. Documenting exits will make you face your trade grades. Reviewing every trade a month or 2 after your exit is one of the best learning experiences you can have. Trading signals that may have appeared vague and uncertain at the right edge of a chart become crystal clear when you view them in the middle of your screen. Returning to your past trades and adding an after-the-trade chart makes you reevaluate your decisions. Now you can clearly see what you did right or wrong. Your journal will be teaching you priceless lessons. I make my strategic decisions on the weekly charts, tactical on the dailies. Since my daily charts are formatted to show 5 to 6 months of data, once a month I spend a few hours reviewing trades that I closed 2 months ago. For example, at the end of March or in the beginning of April, I'll review all trades that I closed out in January. I'll pull up their current charts, mark my entries and exits with arrows, and write a comment on every trade. Let me share 2 examples with you, Figures 59.2 and 59.3. Such reviews teach you what's right with your trading and what needs to be changed. Soon after I started doing my 2 months later reviews, I became aware of two problems with my exits. I noticed that my stops were a bit tight, and that helped me figure out that by slightly increasing the amount of risk, I could substantially reduce the number of whipsaws and come out ahead. I also noticed that while my short-term swing trades tended to be good, I often missed bigger trends that emerged from those short-term moves. I used that knowledge to adjust my methods going forward. Reviewing your equity curve is essential because only a rising curve certifies you as a successful trader. If your equity curve is in a downtrend, your system may be at fault, or your risk management poor, or your discipline lacking. Whatever it is, you must track it down and solve that problem. Still, a combined equity curve for all your trades and accounts is a pretty crude tool. The Trade Journal allows you to zoom in and trace your equity curves for specific markets, strategies, and exit tactics. For example, I can run separate equity curves for longs and shorts, for different strategies and exits, and even for sources of my trade ideas. Believe me, once you see an equity curve for exits marked "couldn't stand the pain," you'll never trade without stops. Conclusion: a journey without an end. How to continue learning. As we near the end of this book, I compliment you on your persistence and commitment. You have worked through the essential trading topics: psychology, tactics, risk management, and record keeping. Still, becoming a successful trader will take more than reading a single book. How long do you think it might take? You may have seen this huge number, 10,000. According to some authors, that's the number of hours it takes to become an expert in major pursuits, such as professions or sports. If that is true and you spend 40 hours per week, 50 weeks a year, it'll take 5 years to become a pro. If you can invest only 20 hours per week, it'll take 10 years. That's a scary thought. If you, like so many people, came to trading after a successful career in another field, be it engineering, farming, or business, you may well have invested that many hours in it. You really want to spend another 10,000 hours on a new project at this stage of your life. Before you shudder at this prospect, let me share a very different number with you: 20 hours. It comes from a book, The First 20 Hours: How to Learn Anything Fast. Its author, Josh Kaufman, makes a sensible point that while becoming a world-class expert will take years, you can achieve a basic level of competence in most fields in a much shorter time. The early hours of practicing something new are always the most frustrating. That's why it's difficult to learn how to speak a new language, play an instrument, hit a golf ball, or shoot great photos. It's so much easier to watch TV or surf the web, he writes. To learn a new skill, you need to find the experts and get their materials, create an action plan, and make an absolute commitment to studying and practicing without any distractions. By completing just 20 hours of focused, deliberate practice, you can go from near zero to performing reasonably well in many fields. Kaufman describes how he took 20 hours to learn several new skills, including windsurfing and programming a website. Even if you take up a more complex activity, such as flying, 20 hours will get you through the ground school and the first few lessons with an instructor. This won't make you a pilot, but 50 hours of flight time should earn you a private pilot's license. The number of hours for mastering basic trading skills is even higher, but much closer to flying than to 10,000 hours. The intellectual demands of trading aren't high. After all, we deal with only 5 numbers: open, high, low, and closing prices plus volume. The main difficulty comes from our emotions. Trading stirs up powerful feelings, the strongest of which are greed and fear. New traders focus on money, dream about what their profits will buy, and throw caution to the wind. They buy as many shares as they can afford and double up on margin. Filled with joyful anticipation, they write down no trade plans. When a trade turns against them, their emotions swing from greed to fear. That's when they freeze while the market grinds down their accounts. Technically, trading isn't very hard. Psychologically, it's the hardest game on the planet. To reduce the stress of trading, keep in mind several essential points. Your trading life depends on following these rules. Trade small sizes while learning. Do not count money while in a trade. Use risk management rules, primarily the 2% rule. Write down your plans, especially these 3 numbers: entry, stop, and target. Keep a trading diary and review it at least once a month. Most traders are terribly isolated and never get to see how others practice their craft. This isolation contributes to impulsive trading. A private trader who violates every rule in the book and makes gross errors remains invisible to others. Nobody will warn him to stay out of trouble or praise him for a good trade. In the old days, our brokers knew what we were doing, but now we place orders online. The only human who may contact you about your trades is the margin clerk at a brokerage firm. Getting a call or an email from him is never good news. I hope that you never meet a margin call, sending good money after bad. To break out of your isolation, to see what good traders are doing, and to be rewarded for your performance, I suggest you look into Spike TradeCom, a website I run with my friend Carrie Lovevorn. That's where traders share ideas and advice, engage in a friendly competition, and comment on each other's trades. Time and again, we see people come in at a fairly basic level, start submitting picks on a voluntary basis, earn performance bonuses, and rise to become serious traders. I wish you success. Trading is one of the hardest pursuits on earth, but it's an endlessly fascinating adventure that can be very rewarding. I've been on this journey for decades and still look forward to every Monday when markets reopen. While trading has made me free, I still catch myself making occasional mistakes and have to concentrate on my discipline. I reserve the right to be smarter tomorrow than I am today. It is a great journey, and I look forward to sharing it with you. Dr. Alexander Elder, New York, Vermont, 2014.